Hello and welcome to the official Singapore market on close. Now let's get straight into the Dubai window where we saw a strengthening of the Dubai physical premium this morning. Seems like in the last few days we found this real floor in the kind of mid 70 cent region around here. Had a bit of a jump back up to 90 cents as of this morning. In terms of the window activity, we have again Totsa and Trafi leading the buy side, while we have some kind of a variety of sellers, Exxon, Unipec, all sorts, PTT. It's quite a diverse sell side compared to that very binary buy side. But one of the interesting things to note in this morning's session was that both Trafi and Totsa were bidding consistently at 64.75, and they were being hit, those bids, by the sellers. But Trafi was also lifting higher offers at 64.79 and 64.80. So that's one of the interesting dynamics to note there in terms of the trading activity. Didn't get any more convergences after we got 5 yesterday. So we're still on 13 for the month so far. Again, all of those have been Upper Zakum and to Totsa and Trafi from a mixture of sellers. But what the big news is overnight is the Ukrainian attack on Novorossiysk, the major Russian terminal for exports into the Baltic, for their exports to the West. Now, that happened, I think it was about an hour and a half of drone and missile attack overnight. And what we've seen in price action is a major jump. So there you can see it doesn't even fit on the graph. If we zoom out, we jumped up by about 40 cents, 50 cents at the open. So this is where we started. Ended the session on last night around 62.70, 62.80. We jumped here on the open, and then as the attack continued, we got all the way up by another $1.50. So there's been a major rally in terms of flat price. We have consolidated, as you can see, through the Asian session into this morning in Europe. But that's a big jump. But even more significantly, if we look at this candle chart of the prompt Brent spread, we have a surge up to almost 60 cents, and that is much stronger than it was. Remember, we were down in like mid 20 cents region just yesterday, all the way down here, and that is a significant strengthening. The question is whether that will immediately come back if this damage to the port is not as extensive as first feared. But this does demonstrate that even if Russian oil is sanctioned, it's kind of off the open market, it still has a major influence on pricing, especially in such large volumes. So that is the one thing to watch today. Likewise, we spoke about the gas oil cracks yesterday, and similarly, they had a significant jump this morning on the open due to this attack. And like Brent flat price, they have had a consolidation coming off a bit during Asian and European morning. But that is the main news of today, and we'll keep you updated with any news coming out of Russia. Thanks.
and welcome to the New Look Officials. I'm your host, Lisa Aziz, and joining me today in the Flux News studio, I'm delighted to say are leading officials. You know them already. Will Cunliffe, Ed Hayden-Briffett, Spiridon Cocos. Welcome, guys. Good to see you. And of course, in this session, you will get all the info you need about the current state of the physical oil and derivatives market, so don't go anywhere. In this episode, we're going to be taking a deep dive into the latest developments, of course, naturally in oil markets. The officials will be discussing where prices are right now and, crucially, why, what's driving the market. After receiving Saudi OSPs last week, I'm sure you remember that, we will now, though, be discussing the new Saudi allocations to Asia and the recent Dubai window action. Right, let us get stuck in and catch up firstly with prices. Where are they at?
Yeah, so we've been in a pretty tight range up until yesterday. We were kind of grinding down towards that kind of $63 handle before prices burst up on the 11th, up to around $65. And we kind of broke that level only just, but that move was faded pretty quickly. And yeah, we dropped all the way down to $62 handle. So the prices have somewhat recovered since then, but I think this market really is kind of being driven by two forces, really. You've got kind of quite a lot of support at the $60 level. That's driven by opportunistic buying. We saw the DOE come out yesterday announcing they're going to buy 1 million barrels of crude. That's not market moving news, really. 100 million barrels a day demand is pretty small, but it does show that you have that opportunistic buying at the bottom. And we know China like to do that too. And at the same time, we've got elevated sanctions, and we've got certain price action in the product market that's providing an uplift. I mean, Spiros, you saw the Chinese export quotas.
Yeah, definitely. I mean, that's actually occurred when we saw this flat price action that Brent went up. It was basically when we heard from market sources that because of Chinese refiners were exporting a lot during the first half of the year, due to their export quotas, they wouldn't be able to export as much of the clean products, so mainly gasoline, diesel, and jet fuel. Yeah. But we saw this steep drop from yesterday, and basically we heard from other market sources that China is now has allowed refiners to switch their low sulfur fuel oil export quotas with the clean product export quotas. So that means more supply in the market and obviously lower prices because that's bearish. What do you think, Ed? What else have we seen in the price action recently?
Well, I think it's basically like Will says, it's been a recent kind of range that we've been in. On the larger scale, it's been kind of 60 to 65. We've declined a bit from kind of September when we got to about 70 briefly, but it does seem like the kind of lower mid 60s is the comfy range. So coming back down to about 63, 63.50 at the moment, that does seem quite good for the market. Like naturally, we have still this narrative of supply surplus, particularly next year. So the IEA is now expecting a more than 4 million barrel per day build supply excess next year. But we've also got, as Will says, this opportunistic buying because it's cheap, right? Oil's cheap, you're incentivized to buy. And that makes sense for China, makes sense now for the US as well, trying to refill the SPR a bit. But I think generally we're in a bit of a holding pattern at the moment. It will
So
take
no particular shocks?
I don't think so. I think it will take a shock. Like the sanctions were a bit of a shock. We had an uplift from about 60 towards 65. But since then, things have cooled off. The market's looking already for kind of workarounds. Although there are still ramifications coming out, so like the Lukoil situation in Iraq where they've declared force majeure, or the specific fuel stations in Bulgaria, Finland, etc. There are lots of ramifications that are kind of working their way out, but on the large scale, I think overall it's going to have a not especially massive impact on pricing.
Yeah, and we saw that in the last wave of Biden sanctions. We saw India scramble for PG grades immediately, and then pretty quickly rotated back to Russian after they realized actually the oil is still flowing. And I think we're seeing a similar pattern now.
Yeah, I think Asia does still have that desire to be buying, and like we saw that in the recent allocations as well. So yeah.
Well, talking of allocations mentioned there, thanks very much. What is the story there then?
Well, if you look at the headline, it says that we've got the lowest Saudi allocation to China that we've ever recorded as the official since we started recording them in July last year. So that looks pretty bearish. It looks like Saudis don't expect that much supply from, demand coming from China. But when you look at the bigger picture, Q4 year on year has actually had higher allocations because we had higher allocations for October, November. It's just December is 500,000 barrels lower than it was last year. So on the kind of aggregate, it's a bit higher.
And you also have to remember that, the Chinese refiners are getting towards the end of their import quota now. So a lot of them are kind of trying to finish that off, basically. And they might have front loaded a lot of that earlier in the quarter. As you can see, we've had very high allocations in kind of October and the last quarter in August as well. But you also have to remember that OSPs, which are kind of in some ways can be seen as a gauge of where the Saudis would place Chinese demand. They came out a bit firmer than structures implied, as we discussed last podcast.
Yeah. And you raised some interesting points. OSPs came firmer, and that implies demand in Asia is actually quite good. India, we've heard allocations to India were up significantly month to month, and Japan as well. So this demand. We see the Chinese allocations might be down, but Asia as a whole is actually remains robust. The demand is there. So the Saudis see something that obviously some of the market participants didn't really realize with these Chinese allocations.
And you mentioned as well the kind of finishing off their quota or their contractual agreement. I think an example of that was Rongsheng, because they're on the chart. They're normally the biggest one. They're the light blue bar.
Yeah.
So typically you see them taking a lot of barrels, like 14, 15, 16 million barrels each month. This month it was significantly lower. It was down at 8 or 9 million. So that looks like a big decrease. It suggests on the surface lack of demand. However, we did hear that was to complete their kind of contractual quarterly and annual obligations, both on quota and kind of term lifting obligations. So really it's kind of, in that sense, that's somewhat mechanical and shouldn't worry the market too much.
Talking of worrying the market, what about people who are new to your show? Would they necessarily be worried about that? Or, we are approaching, as you say, year end.
I don't think you should be particularly worried about this because, as we said, compared to December last year, it's only 500,000 barrels less.
Which in the great scheme of things is
it's not a
nothing,
big deal, really. It's down a lot from October and November because they were particularly high. So it's down 3.5 million barrels from November. So that month on month, it's big. Year on year, not so big. And as I said before, quarter on quarter on the aggregate of the 3 months, it's actually higher than 2024. So there is still some strength in China.
Yeah. Although I would also stress that for the most part of this year, we've had very big inventory builds in China. Especially in Q1, Q2, we had sort of 1.2 to 1.5 million barrels per day of believed SPR purchases. And, I think this is, in some ways, this could be a bit of a concern that perhaps China have taken the foot off the pedal in terms of SPR purchases. Perhaps they've rotated back some of that, some flows diverted from the PG grades back to Russia, perhaps. But I don't know. The window action, at least, from my perspective, it looks like China are being a little bit softer.
Yeah, well, some of the Chinese in Dubai, particularly, they've been on the sell side, right? And that's been kind of one of the narrative drivers in the Dubai window that we've seen recently.
Okay, let's move on. We've seen them reduced allocations to China. We've been discussing about that. But is that being reflected, say, in the spot market?
Well, definitely. I mean, the Dubai window action has been relatively strong. Obviously, not as strong as the previous month, but we've seen some increased demand mainly from Trafigura and Total right now. They're the main buyers of Upper Zakum because we had 13 convergences this month so far, all Upper Zakum.
Yeah, 5 of them this morning.
5 of them this morning, exactly. And we've seen players on the sell side. It's mostly Exxon, Phillips, we saw some BP this morning, but as you said, that mainly is China selling right now. PetroChina, interestingly, hasn't really stepped up compared to the previous months. They've been a net seller usually, and this month they've been very silent. That's fair to say, right?
Yeah, I mean, it's been a very different, a welcome change on this in Dubai compared to last month. Last month we only had really Mercurius selling in the first half and then flipping to the buy side in the second half. They're still on the sell side, Mercuria, but yeah, you're right. Mostly it has been been the Chinese majors, and we've seen the premium take a hit off the back of that. You know, we started very strong at the start of the month, but that collapsed pretty quickly, and now we're back down in this kind of mid 70 cents range on the premium. I mean, it looks like, looking at the chart here, it looks like that's a pretty well established floor, and I think, you know, probably going to find some support here, but.
Yeah, I'm inclined to agree. And as we look at that chart, and we mentioned previously that the OSPs were a bit stronger than the structure implied, you can see on the last, not this month, but the previous 2 months, so September and October trading, the drop in the average was about $1.60, but the Saudis actually cut by 120 and 140 for their grades to Asia, whether it's light or medium heavy, etc. So that's where kind of that structural argument comes into the OSP setting, into the allocation kind of process. But as you say, we had a very strong start to the month because we had a really choppy end of last month, and that fed into the beginning of this month, and then we had a pretty dramatic fall. Since about the second or third session, we've been gradually grinding lower, and as you say, we're stuck now in kind of the mid 70-cent range. I think it was 75.5 cents this morning, assessed by us. And it is dragging down the average because, as you can see, we're like 113 or so on the average for this month. That's distorted by the early assessment, which I think was above $3 for the first session. So that'll be an interesting one, how the Saudis actually manage that in terms of the next OSPs.
When you see a drop like that, though, I mean, to me, you know, talking to you experts, it does look pretty dramatic. So one wonders what the drivers will have been there.
I mean, spreads remain depressed all over the world. We see WTI spreads and Brent spreads are around, for example, Brent is around 25 cents for the prompt spread, up to 30.
WTI went contango today.
WTI went in contango yesterday, and it's trading around parity right now. So basically the question is, how much oil is on water right now? How much oil is in transit, and how much oil is just left on tankers that are not moving? That's the main question. Everybody has been talking about this super glut. We saw this various agencies coming with almost $5 million barrel builds heading into Q1 next year. So that's the main theme right now, and the market tries to understand where we're heading next. So that's why the spreads remain quite tight.
Yeah,
right now.
I would like to challenge that oil on water narrative though, because it's been going for probably a month now, and it's been this kind of big discussion about how much oil is literally on the sea, traveling or in floating storage. And I saw a story this morning about JP Morgan saying something like a third of Russian export capacity was on water. And that's like millions of barrels per day, 1.5 million barrels per day. That doesn't really make sense just from a logistical point of view. It can't be just sitting on ships. There, for one thing, aren't enough ships, and it's way too expensive.
And also, you know, that means that pretty, like last month, there was a notable uptick in production. We're not seeing that come through in any of the production data. So it's, okay, yeah, we've had this huge accumulation supposedly of oil on the water, but where did that oil actually come from, and where's it going? I mean, we know that refineries are in turnaround at the moment, hence why, you know, refinery margins are so high. So to me, that narrative doesn't necessarily make that much sense. And it kind of, it comes back to this, as you talked about the super glut, right? That has been a narrative that's been building for kind of the past 2 quarters, really. We started to see global balances, projected global balances turn into surplus earlier in the year, and they've only got deeper and deeper into surplus. And now we're at the place where the IEA, and I think it was Macquarie, was it, who were projecting, you know, 4+ million barrel builds for Q1 next year.
Yeah.
A story like that, though, could it just be wrong? Could it just be fake?
Yeah, it could be.
You know, you're experts and you're saying you don't know where that's come from. Could it just be wrong?
It could be wrong. It could just be a misinterpretation of the data. It could just be understanding of the numbers, because if you have X amount of refinery capacity taken offline in Russia by Ukrainian drone strikes, you then perhaps assume that it's immediately going into exports. Might not necessarily be the case, and it can just be an error in the arithmetic.
Yeah, and I mean, I think, you know, the fundamental picture at the moment is not great. You know, like from a macro perspective, we have pretty soft data coming out about the labor market in the US, with China as well. We got their new yuan loan growth today, and that's continued to downtrend. I mean, that's the weakest since the data started, now at 6.5% year on year, and disappointing to the downside. And that, for me, that's the main barometer of the health of the consumer base in China. And the fact that that is not ticking up, I think, is very concerning. So yeah, demand is soft, but I think what a lot of people are missing is that the supply narrative hasn't really changed that much. We've got a little bit more coming out of the Saudis. We've got a little bit more coming out of US shale. But other than that, I mean, where are you seeing all of this extra supply growth come from?
I mean, everybody's talking about these OPEC quotas, right? So we know these are paper barrels. We know some of those countries already produce even more than what they report they produce. So quite frankly, these numbers are just totally fake. We shouldn't even consider those.
Yeah, I think the most laughable one is the Kazakhstan compensation schedule, where they say that in like June, July next year, they're going to reduce production by 650,000 barrels per day to compensate for previous overproduction. And I think really one of the only places that you can actually see more production come out is Guyana. I mean, they've just brought online a new stream. I think it's called Yellowtail, or Golden Arrowhead, sorry. Yeah. And that's one where it is actually increasing production, but on the aggregate, that's not going to make a huge difference to justify these 4 million barrel build.
5 million barrel build, no.
Right. Well, that just about sums up Dubai and more. What about the North Sea?
Well, that's been a fun ride the last week or so. Yeah, so I mean, as you can see on the chart, the dated Brent physical differential, well, it dive bombed, completely collapsed. That's the softest physical differential we've had since we started tracking. I mean, below -$1. And I mean, what we've seen Vitol dumping a lot of Midland in the window. I mean, they pulled cargoes from chains, didn't they, Spiros?
Yeah, they did. I think from chains it was at least 13, let's say.
Yeah,
at least 13 to 15. They also bought last week 2 Midland cargoes on the window, so call it 15, 17 cargoes they had, and now they've started selling. We heard from some trading sources, they on paper they had a very large short position.
Yeah.
So that implies some traders were already expecting that big drop to happen from Thursday, Friday, which did actually. But on Monday it was a shock. It was a nice mix of all the grades being, especially Midland, being deeply negatively offered on a full basis.
I mean, Ecofisk and Midland, they were the softest, I think, since 2021, right? So, I mean, this is a big move. I mean, from trading sources that I've been speaking to, I think, Vitol probably aren't going to be so actively offering next week. So perhaps we see a return back to more neutral physical differential. But yeah, I mean, it's violent move.
Yeah, and it's been pretty choppy actually lately through kind of the end of September, as you can see on the chart. We had a big jump, bit of consolidation, sudden drop, aggressive jump up again, then this Armageddon kind of situation. We had to extend the axis on the graph because it went off the bottom. But yeah, I think I agree that Vitol's probably had its fun now. Maybe we'll take a step back. We could see a bit of a consolidation in the diff rising towards more normal levels. But that does require somebody to be brave and come and bid.
Yeah, exactly.
With the threat looming that they know that Vitol has been just so aggressive recently. No, it could be anybody, but someone brave.
And Vitol, yeah, they've been selling a lot, but they still have a lot of bullets left.
Exactly.
I believe they have 17 cargoes.
Yeah, with what we've seen in the window, they haven't sold many Midland. From memory, it's like 3, 4 maybe, if I'm not mistaken.
Yeah.
So they should have more bullets, as you say, Will, rightly. Obviously, over the counter, that's a different story that we can only listen to trading sources. But I believe I'm also inclined, as Ed mentioned, that we should see some recovery now going forward.
My next question would be really the 40s curve and how that relates to Midland, because we saw Midland get slammed really aggressively early this week, but 40s has also been descending to become more competitive against Midland again. So I think if we see some bids coming in for Midland, we could end up seeing 40s begin to set at least some of the curve, maybe the whole thing. But I think it's at the back principally that 40s is closely competitive against Midland. So that will be one to watch, the intergrade dynamic there.
When a chart then literally drops off a cliff like that, give the viewers a sense of sentiment on the desk. Do you all go silent, just look at each other? Is it a scary moment?
I mean, we're kind of building the curves, right? So we're looking, okay, so where was the CFD trading? And we were like, wow, the front's pretty negative. Where's the cash spread? Okay, that's still around like 30 cents, so nothing to worry about there. And then you're like, wow, okay, so a lot of these trades were done BFOE related, not a data related. So we're there working out what that implies data related, building the curve, and Midland was absolutely crushed. It was like, everyone get round, look at this.
I bet.
One of the other factors is as well freight. Freight is so expensive.
Freight's so
now.
expensive,
I mean,
yeah.
the Sullenbo Rotterdam route is getting near $2. That's the highest we've seen in a long time. I can't remember when it has been as high as that. Certainly not for a long time. So that's another factor when you have to consider the CIF to FOB conversion. And I think freight being expensive has been a narrative as well in the market the last couple of months as well.
Yeah. Well, again, it comes back to sanctions, doesn't it?
Yeah.
I mean, the amount of unsanctioned dirty tankerage is decreasing pretty rapidly, at least more rapidly than new dirty tankerage is coming onto the scene. So that's going to constrain.
Well, yeah, 9 times out of 10 it
At
comes
least-
back to some geopolitical story,
At
doesn't it?
least, obviously, with the tankers, we had some interesting stories this week. It was China, right? They announced that they would cancel those port fees that they had implemented to the US. So that's a positive. That's a positive piece of information that we received.
Definitely.
We see some sort of recovery in those relationships. So they started buying soybeans, they started buying other products, they cancelled the port fees. The US, quite similarly, is moving in that direction, trying to build the relationship. So, the sanction ships, that's a big question, but at least from the Asia and the US side, it seems like everything is slightly heading towards better outcome.
We can hope.
I think we can have a whole show just on those ships. Be good. Just finally then, to the story of the week.
Well, I think it's got to be gas oil. That's been absolutely ripping the past past month and a half, I'd say. And then the news came about the Chinese quotas, and it softened a little bit. We're seeing a bit of a reversal and now consolidation today. So we ripped up to almost it was $42.
Yeah, the prompt heating oil swap crack, as you say, got up to almost $42 on, what was it, Tuesday. And it was already at very elevated levels because, as you can see on the chart, we'd been spending most of September, October, $30 a barrel kind of area. That was after having jumped on the Israel-Iran war back in June. It hadn't really come off that much
Already
since then during the summer. So it was already pretty elevated. Then we get this kind of continuous, steady rapid rally up towards 40, and then the sanctions as well don't help that situation. In kind of late October, they help to boost it more, and up to nearly $42. And I think a lot of it comes down to the sanctions, refinery maintenance in key kind of swing barrel areas, like we saw Al Zour refinery in Kuwait.
Yeah.
That's not expected to come back online until 9th of December, according to our sources. India as well has had some unplanned maintenance, plus of course the stocks story in the US.
And heavy turnarounds in Europe, Dangote offline. There's a lot of maintenance at the moment, which has been kind of pretty constructive. A lot of product cracks.
Yeah.
I think also from a technical perspective, a lot of people were starting to get short gas oil and heating oil. I think it was seen to be a little bit overextended. So it just needed that one little impulse to kind of trigger those stops and then see that dramatic move to the upside. And people I've spoke to, a lot have been burned on that trade.
Last word?
Yeah, over to stocks. I mean, we expect the EIA stocks to come at 3:30 UK time. Obviously, this podcast is recorded a bit earlier, so we've seen here the stocks are running below the average, below the 4 or 5 year averages, and we are pretty bad right now. Distillate stocks in the US are very, very low, and obviously that's another that's obviously put upward pressure on heating oil. And quite frankly, it would be interesting to see where the EIA stocks come this week. But I believe this heating oil swap crack should trade around an elevated range for the time.
Yeah, I think as well as noting that the stocks are low, I think what you have to look at is the rate that they've been depleted.
Yeah.
And if you compare, so the red line to the black dotted line is the average of 2020 to 2024, whereas 2025, you can see that they were actually quite close, kind of early October, end of September, and then suddenly this year they've just been depleted repeatedly and rapidly, and that I think is causing some concern. So it's at a faster than usual seasonal rate.
Yeah, well, I mean, we've had a pretty severe kind of cold weather snap in the US, which I think has driven a lot of that accelerated depletion. It'll be interesting. I mean, it's expected to not necessarily be maintained throughout the cold winter season. It's not meant to be as severe necessarily as what we've seen so far. So it'll be interesting to see if they can up refinery utilization a bit. I mean, the cracks are so strong. I don't know why the refineries wouldn't increase their utilization, but that's been pretty soft in recent Heilperns.
Yeah, you should be right about the capacity right now. If you're a refiner. But it's interesting also over Europe. You mentioned Finland is actually, from memory, at least 20% of pump stations are actually affected by Lukoil, so that implies more diesel demand obviously in Europe. Now with Bulgaria, we don't really know what's the situation. We've been hearing a couple of stories. So yeah, it's interesting to see how those sanctions will play. Europe is definitely affected by that. Also, Al Zour refinery, Europe is a major importer of gas oil and jet from Kuwait. So yeah, it will be interesting to see.
Yeah, I'd like to kind of soften that slightly though, because unlike the US, where we've seen these repeated significant draws on the distillate stocks, gas oil stocks in ARA have actually got to above their 5-year average. So there is a bit of a cushion, but there is still, I think, in the market's mind, a lot of concern about the Russia sanctions, both in terms of secondary sanctions on particularly Indian and Turkish refined diesel, plus, of course, just the direct consequence on distillate pricing, because a lot of it is obviously medium sour and yields gas oil. So Europe has a bit of a cushion, but it shouldn't feel too comfortable because it is cold out there.
We'll see if it all remains comfy. Thank you so much, because that is it for this particular session of The Officials. Remember, you can see all of our Flux live shows on whatever platform you wish, whenever you want. And remember too, if you've got any questions or comments, get them into us, get involved. We will see you next time.
welcome to Trading Corner. We're just going to debrief on the market for the last week, see where things stand and where we go from here. So, margins. I mean, look at this chart.
Just flying.
That is unbelievable. This is from May we've got, but we're at yearly highs, right?
We are.
Incredible.
Yeah, it's been the single most performant trade of the year. And gas oil obviously driving an enormous amount of that.
Yeah. So this week it's been mainly gas oil, right?
Correct. Actually, you've seen some of the other products correct slightly lower. Gas oil and gasoline have been the standout performers, I would say.
Why do you think? What do you think is going on there?
Again, I mean, we're seasonally coming into the most strong season of gas oil, right? So gasoline is a separate story, but gas oil for sure. There's an enormous amount of positioning in gas oil as well. You've got
To the long side.
To the long side, which is creating an enormous amount of noise in gas oil. I mean, interestingly, the back has been relatively more stable and performing. The front is where the noise is, as is always. But I think we could see more noise. I assume there have been some stop outs on the short side with this gas oil move last week, but you don't know.
Yeah, also just looking at the charts, I mean, the behavior, it definitely looks like there's a lot of buying in the morning. Typically into the evening, we tend to trend down a little bit, but then it catches a bit right, like the next morning.
Yeah, exactly.
And just totally reverts the sell-off that you get. So we're slowly trending up, but it definitely looks Asian-led.
And actually, Asia has got a lot of strength and is showing a lot of strength on the gas side as well.
Which is unusual for this time of year, right? As in, usually India should be exporting gas oil, and it doesn't look like they're doing that.
I think it's probably due to the crude slates that are coming in, or the uncertainty around what crude is being bought. It's just my theory, to be honest, but. We're also, there's cold weather starting to come in. We've got a bit of a cold snap in the U.S. Still not that cold in Europe, but I think in about a month or so we'll be able to tell. And
it does
it's
feel
going
like
to draw.
It feels like we're having our winters later and later.
Correct.
So the classic. I think maybe 2-3 years ago we had a big Texas freeze in January.
Yes.
So it might look like actually a lot more of the cold weather will hit in the new year rather than. We're in mid-November and it's 15 degrees. It's crazy. It's crazy. So that might be why. But to be honest, like if you look at the whole complex, so margins and also what crude's doing, it just looks like refineries are not running anything.
We don't have enough capacity in the world.
Yeah.
That's the only explanation.
So obviously we had the Lukoil stuff. Some of their refineries got hit by some of the Ukraine missiles. Not that much though.
Yeah,
the only other refinery we're talking about is Dangote. So
correct, and actually, we haven't really seen refiners come fully back out of turnarounds.
No,
I suppose so. That is possibly one reason. And again, I think 2 weeks ago we talked about products trading independently as products, and it's not that everything in the margin is rallying, right? A lot of this is primarily due to gas oil. There's a decent amount of gasoline strength also, but fuel has corrected down. Fuel sold off a substantial amount in the prompt cracks. Naphtha's kind of just hanging around as well. It's not. It was up a little bit last week. It's a little bit further down now, but nothing to write home about really, because I think the light end of the margin is really what people are looking at.
Yeah, really performing.
Yeah.
It's so true. But then the report, so just back to the slates quickly, the reports that we're seeing on production, so like, global production, let's look at the US, typically a lighter slate, should be more naphthenic, potentially gas oil and distillate producing. There's a lot of production coming out of the US at the minute. I mean, I think I read that Chevron are at max production.
Correct.
So there's a lot of light sweet around, and the stuff that's not getting bought, potentially Russian, OPEC holding back, that's the fuel dominating crude barrels. So it's quite interesting to see that.
You would think the opposite, right?
Yeah, exactly. Just for the the waste barrels, the one non-middle distillates. It's quite interesting that it's happening that way round.
Yeah, and it is interesting, and I would agree with you. You'd normally think that actually as we discussed actually last week, we think the light heavy margin might compress
Yeah.
a little bit, but that's the exact opposite is
Yeah.
happening.
Very interesting.
I think on the light side, or the lighter side, I should say, naphtha is largely being driven by gasoline at the moment. The gasoline strength is the feature.
Into the blending pool.
Yes.
Yeah.
Yes. I mean, there is proper gas snap hedging, that's been active over the last few days, especially on this gasoline strength. And then it feels like the ARB is actually open. So with the amount of strength that we're seeing in European gasoline, I feel that there's probably going to be some fixtures going
From the US.
No, to the US.
Oh, to the US.
Yeah, to the US.
Oh, I see. So it's a US product strength that's pulling everything up.
It was the US product strength that was pulling everything up. Now I feel like it's Europe that's keeping everything up
Okay.
on the gasoline side.
So I guess until we start, getting these run rates back to 100,
Yeah.
we should expect this kind of spot buying. So it's predominantly in the front, right? So we should expect that to remain. To be honest, seasonally, the refiners should be back. I think it's imminent they will be back.
I imagine so,
They
yes.
should be buying, over the last week or so for kind of mid-north, deck
And
for
deck-
sure.
deck
Given
for
these
sure.
margins, they have to run 100%. I mean, it's a bit
Correct.
silly not to.
Correct.
So
So
just
is it a demand side story then?
well, it seems like it. I mean, I think this whole year has been very whipsawy. I think, the positioning has just been crushed. I think there's not a whole lot of confidence on the curve, and so people are just a bit jittery, it seems like.
It's really interesting that you said there, just because we are coming into the new year, right? There's a lot of firms that are going to be wrapping up the end of the year.
Yeah.
And I think it's not something to ignore, because in addition to wrapping up the end of the year, there's a lot of companies, traders, that P&Ls start flat in the
Yeah.
new year. And there's probably a lot of planning going on for what risk is going to be put on in the
Yeah,
market
what
in
Q1
Q1.
will look like. Exactly.
Correct.
And we
I think
might
it's worth talking about that.
Yeah, no, it's true. I think, all year the market's been looking for a different rhetoric for next year.
Yeah.
And the closer it gets, you need to start then looking to position, etc.
Yeah.
A lot of refiners as well, they might be clearing out their crude stocks. So it might be why we're seeing a lack of buying in crude specifically. But it does seem like it's Dubai-led, to be honest. So all year, Dubai has held up the whole crude market.
Yep.
Really exceptionally, to be honest. And it's just totally flatlined the last week or so. We had fairly good expectations for pricing. I think the first day of pricing was around 130 on the spread. We're currently pricing 50 cents. So really there's been a lot of subdued activity, like not aggressive,
Not
that much.
spectacular, yeah.
No, it's really quite underwhelming, to be honest. And seeing as Dubai has been the one that's led the crude market, everything else is also quite soft. So just looking at dated quickly, I mean, we had this, bull play for October and November. Trade House took predominantly all of the cargoes for those 2 months loading. Now I think what's happened is most of those barrels have probably cleared. There are probably still a few around, and so we've got this front overhang. But despite the margins, the market is not confident enough. Given that strong rally, you need to let the market reset at some point. To be honest, I thought we had it before the sanctions. We hit quite low on all the spreads. The diff came down, and then that short.
Allowed.
The short covering came back in, but I don't think that's how the market wanted to have that short covering rally.
Okay.
So now it's happened. You've just stopped people out on both sides.
No man's land a bit.
We're in no man's land, so
Yeah.
it's just super sensitive to flow. If one person comes in doing something, you can just see the market gravitate whichever way that's going.
Yeah.
It's just showing a lack of liquidity and positioning.
It does feel very liquid. It feels
Yeah.
extremely, we discussed this last week. The market is going to be flow driven for the rest of the year.
Definitely, but right now, in crude at the least, there is a lack of flow until these refiners come back and they start purchasing. But again, it could be a contagion. As soon as one buys, the next, we'll have
A little bit of herd
Yeah.
effect.
So I think it'll be very momentum based, which could be good for the market, to be honest.
Yeah, probably, and I think you'll see the same thing on products, and I
Yeah.
think it's going to be thin for the next probably all the way to the end of December, I
Yeah.
would say.
And we have Thanksgiving before that as
You've
well.
got Thanksgiving, and then you've got Christmas coming up. A lot of people on holiday, a lot of people on winding books. But importantly, also, there's probably going to be a lot of positioning of the market for the new year,
Yeah.
pre-positioning of risk and risk for the new year. And I think if you look at it psychologically, it's probably going to continue driving products up.
Yeah. It looks like it.
Yeah, and so the question really is the margin hedging sufficient to just take out? Sorry, is the product buying going to be sufficient to take out the margin hedging? And
Yeah.
I would suspect so.
Yeah. Well, that's the other thing. I think one of our fuel guys was saying last week we saw a reversal of the margin hedging from spec buyers, I
Yeah.
assume, like funds, etc. People that don't need to actually hedge the margin. So those that were trying to catch the highs. But you go from, I mean, just quickly here, they were probably hedging around $8-9. We're now at 11.5.
Yeah.
Hit 12 on Friday. A refiner's going to be running at 100% at 8, still 100% at 11.5. So it's kind of immaterial.
Because this is obviously deck margins, right?
This is currently it's rolling month 1, so it's
So prompt margins.
Exactly.
Right? I'd be curious to see what Q1 margins look like because if we're talking about momentum and we're talking about risk coming into the new year and what's worked this year, which has been product length, crack roll length, and those have been themes that have been working consistently over the past year. I think you'll find that there might be a lot of trade that comes in to buy, or traders rather, that come in to just reload on products, looking at a potential margin roll up.
Yeah, to be honest, we have had that. I mean, I remember looking at it last month, and the margins were around $9-10, $10, I think. We rolled on the month, and I think we rolled
They
to 8.
dropped a little bit, and
then
boom.
they boom,
Yeah,
all the way
exactly.
back up, and through the highs.
Correct.
So yeah, totally right. We could definitely see that. But yeah, very interesting dynamic. I think.
Yeah.
It's I just don't think we can
For me,
take this gas oil as like it's here to stay. It feels like it's here to stay.
the gas oil strength.
Yeah, I don't think that's. The
I don't think
contrarian.
that's going anywhere.
Yeah, I don't think.
I think,
it's
in
a contrarian
fact,
trade.
I think it's not. I think you're probably going to continue to see strength all the way through to next year.
Yeah.
Which is going to keep the margin high. So what corrects on the back of it, right? Maybe naphtha a little bit, maybe fuel a little
Yeah.
bit. But the reality is that there's and any demand will probably take a lot of that out, and I think it's the prompt margins are a bit scary when they're this high to be just constantly long. But I mean, I like margins further back.
Yeah.
I think it gives
For their
you
roll up.
not just for their roll up, just looking at the price of product spreads further back and the price of and crude further back. I think I'm still convinced that we have to move up on crude.
Yeah.
And if anything is going to come in the balancing factor for margins, I think it should be crude strength.
I agree. I totally agree. It's just a matter of when. It's very much a timing game at the minute. So that's kind of the price action we've seen. Just quickly geopolitically, it's hard not to really talk about it,
Yeah,
but
we should.
we're still waiting for this deadline, November 21st, to come in for the Russian oil sanctions. Maybe that's what's put the market in limbo a little bit. But since over the weekend we had, China, US drop their sanctions on the ports, which
Correct.
it should help TI, I think. So
Yep.
I still like the TI Brent trade. I think that's I think that will perform, just despite if the sanctions do go ahead, US will be bought. If the ports, and US-China tensions totally relax, US will also be bought into China, into the east. So I do think US is the barrel that you want to be buying. Currently, it's also landing very cheaply in the North Sea. So when refiners do come out and buy, it's likely that that's the barrel that they will want to purchase.
That's going to be the marginal barrel that's going to define it.
Exactly. So freight's still a little bit toppy, but it does feel as time goes, the geopolitical premium is narrowing. So I do think that the freight will also start to come off a little bit.
Yeah, and I think tariffs are a really important factor in freight. To be honest, I know that's not the only factor, but I think we've had a lot of tariff-related headlines this year.
Yeah.
There's still a lot of uncertainty around some countries, but over the past week or so, especially with Trump's trip to Asia, there have been more and more trade deals being struck, and it does feel like things are normalizing to this tariff world. And I say that with a bit of caution because obviously we're, speculating Trump's policy on tariffs is a little bit difficult.
It does feel though the last week or so he has softened his stance quite a lot. I mean, I think I can't remember what country exactly, was it Hungary, where he's just said, don't worry about the sanctions. You can purchase Russian oil, it's all good.
Yeah.
So it does look like his stance is starting to soften. So I do totally agree with you there. But then we still have potential upside or downside risk as soon as he comes out.
Yeah.
So it's just a bit of a...
It's like I think, and the market's trading that way,
market,
both crude and products. I mean, a lot of people are just a bit, I'm going to stay out.
skittish, exactly.
And wait for some high conviction moves.
Yeah.
Or I think traders can be inventorying risk further back in the curve where it's a little less volatile and maybe more high conviction. And that's my approach at the moment. I still like those back end margins.
Yeah.
Not all products, some.
Yeah.
I'm not going to go short gas oil, but even gasoline, I think it's, we're in winter gasoline here.
Yeah.
I know, I understand.
Where's the crack?
It's 15.30 in deck or something like that, and
Wow.
it's and that's, I understand that we have a tight complex in gasoline. There's some tightness in Asia. We're pricing strong in November, but driving demand, any general end user gasoline demand is going to dip off as we get colder and colder across the globe, so across the West, I should say. And I'm not really convinced on the gasoline strength, and I think that could be a part of the margin that does correct.
Yeah. Well, let's see.
But like I said, it could be insignificant.
It could.
Because 11, 10, 9,
No, exactly. Yeah.
all profitable. Right?
Okay, cool. So just talk about high conviction. What's your trade into the next week then?
I'm actually gonna say short gas snaps. I like to be short some gas snaps probably in the summer, Q1 of the summer, and then still long back end margins.
Okay, perfect. And for me, I still like the TI Brent boxes, so that's definitely been kept on for 2 weeks ago. Last week was long NovDeg. That has not performed. I still do like it though. I think the risk reward is to the upside. It looks to me as though it's been oversold. If any kind of marginal refiner buying comes in, that is the contract that's going to move. Also, DEC Jan, we've got really strong margins. There's no reason that DEC should be underperforming given where the products are, potential run rates that we're going to get into December. But obviously, you need to be cautious around Christmas week, etc. So it probably looks like long DEC structure is probably the crude trade for now.
Sounds
Okay,
good.
cool.
In agreement.
We'll see where we are next week. Thank you.
Thank you.
Hello and welcome to the official Singapore market on close. Now let's get straight into the Dubai window where we saw a strengthening of the Dubai physical premium this morning. Seems like in the last few days we found this real floor in the kind of mid 70 cent region around here. Had a bit of a jump back up to 90 cents as of this morning. In terms of the window activity, we have again Totsa and Trafi leading the buy side, while we have some kind of a variety of sellers, Exxon, Unipec, all sorts, PTT. It's quite a diverse sell side compared to that very binary buy side. But one of the interesting things to note in this morning's session was that both Trafi and Totsa were bidding consistently at 64.75, and they were being hit, those bids, by the sellers. But Trafi was also lifting higher offers at 64.79 and 64.80. So that's one of the interesting dynamics to note there in terms of the trading activity. Didn't get any more convergences after we got 5 yesterday. So we're still on 13 for the month so far. Again, all of those have been Upper Zakum and to Totsa and Trafi from a mixture of sellers. But what the big news is overnight is the Ukrainian attack on Novorossiysk, the major Russian terminal for exports into the Baltic, for their exports to the West. Now, that happened, I think it was about an hour and a half of drone and missile attack overnight. And what we've seen in price action is a major jump. So there you can see it doesn't even fit on the graph. If we zoom out, we jumped up by about 40 cents, 50 cents at the open. So this is where we started. Ended the session on last night around 62.70, 62.80. We jumped here on the open, and then as the attack continued, we got all the way up by another $1.50. So there's been a major rally in terms of flat price. We have consolidated, as you can see, through the Asian session into this morning in Europe. But that's a big jump. But even more significantly, if we look at this candle chart of the prompt Brent spread, we have a surge up to almost 60 cents, and that is much stronger than it was. Remember, we were down in like mid 20 cents region just yesterday, all the way down here, and that is a significant strengthening. The question is whether that will immediately come back if this damage to the port is not as extensive as first feared. But this does demonstrate that even if Russian oil is sanctioned, it's kind of off the open market, it still has a major influence on pricing, especially in such large volumes. So that is the one thing to watch today. Likewise, we spoke about the gas oil cracks yesterday, and similarly, they had a significant jump this morning on the open due to this attack. And like Brent flat price, they have had a consolidation coming off a bit during Asian and European morning. But that is the main news of today, and we will keep you updated with any news coming out of Russia.
welcome to another episode of Flux Insights. I'm Lisa Aziz, your host for today's exciting show. And joining me for this episode are key members of Flux's research team, Research Associate Meeta Chaturvedi and Quantitative Analyst Giovanni Simonetti. So each week, our fabulous research team will dissect the latest trends shaping the oil market, which, as we all know, influences everything from geopolitical events, conflicts, inflation, right along to how much our energy bills could increase by this wintertime and how much we just might end up paying, say, at the petrol station to fill up our cars ahead of the weekend trip out. So with Flux's proprietary financial positioning data, we deliver a view of the oil market that you just won't find anywhere else. We're at the forefront of early trend shifts and can convert them into practical, actionable opportunities. In the next 30 minutes, we're going to be covering recent happenings in the market, followed by a positioning review, a deep dive into an interesting swap contract, technical analysis of the oil market, and a trade idea for the week. Watch out for that one. So with all that in mind then, Giovanni, firstly, let me ask you, what's been the big mover in crude oil futures this week?
Well, the story today has been the IEA has revised its forecast for global demand for gas and oil. So originally it had said that demand would start curbing and falling around 2030, but as we can now see from this chart here, the IEA has now forecasted oil to grow up until 2050. Now, originally from the chart, we can sort of see that they'd optimistically said 2025 is when oil would start, demand would start falling, but they've revised it last year to be 2030, and now they've just said, no, it's probably going to grow up until 2050. And this has very clearly been driven by the need for energy in AI data centers. We've also had some more news coming out from the Russian sanctions. So Lukoil, who had been previously massively impacted by these US sanctions on Russian companies, is now also in a bit of trouble in Iraq, where they are unable to access one of the largest oil fields, which happens to be one of the largest oil fields in the world. So they've literally they literally can't really do much with it right now. They're also in a bit of trouble in Bulgaria as well, where the Bulgarian government has taken over the largest refinery in there. So yeah, it's a bit of trouble coming ahead for Lukoil. We're also seeing some more news in the Middle East, where Saudi Arabia has announced their oil allocations for China, which has dropped quite a bit. It's the lowest since July 2024 at 36 million barrels, and it's dropped by about 3.5 million barrels compared to November. So this here is the Saudi allocations to China. So this is provided from the officials, and as we can see, December, there's a massive drop off compared to the previous months. It still is only 500,000 barrels lower than December in the previous year, and the Q4 is still a stronger Q4 than Q4 in 2024.
Brilliant. So, Meeta, let's move on now then to refined products, if we may, because we've noticed over many, many months already, haven't we, that margins, they remain on the up. So what's the latest?
So as you said, refinery margins, that's the front month margins, have been their highest over the past year. As you can see on my chart over here, they've been steadily going up throughout this year, and a lot of this trend has emerged from the gas oil or diesel complex and from the gasoline complex. So starting with gas oil, so the front month swap crack has rallied to a high of $35 this week, where it met resistance, and it's currently around $33. The $34 is still $35 is still a very important level of resistance, so keep an eye on that. And this tightness is currently at among its highest level since 2022, which was the year Russia invaded Ukraine, and that led to a whole energy crisis after Western sanctions on Russia. So given that levels are now at similar levels to at that time of the year, there is a definite tightness that the market is pricing in right now, and a lot of this has been due to refinery outages in the east and among geopolitical risk from sanctions on Russian oil majors, especially with Gunvor's bid to buy Lukoil's international assets now falling through.
Actually, at this point then, Meeta, let me just ask you to highlight some of those recent concerns around export tightness out of Asia. Tell us a little bit more about what's happening.
So right now we've got refinery maintenance and refinery outages in Asia, which has led to significant tightness from that region. And more recently, Chinese refiners have slashed their exports of gasoline, diesel, and jet fuel in November to 2.9 million metric tons. They may reduce this further to 2.36 million metric tons in December, and this compares to a Jan to Oct average. This is a monthly average for the rest from January to October of this year of 3.47 million metric tons. So fairly significant decline, and this decline has been due to export constraints out of the region. And so that may lead to further tightness as China slashes its exports. On the demand side for residential heating, which which heating oil, which is also distillate, is often used for. Next week is expected to be colder in the UK, but in the US, signs are emerging that the Arctic polar vortex may weaken further into December, allowing frigid air to move southward, intensifying fears of colder weather. US distillate stocks relative to product supplied, so product supplied is a proxy for demand, currently stands at their lowest level except for during 2022 and 2023 for this time of the year. And further, so it'll be important to see the official US stock data over the next few weeks. Tomorrow's is going to be the most recent, is going to be this week's data. It's going to be important to see if we see further stock draws. If that's the case, then refining margins could stay supported. On the gasoline side of things, we will talk about gasoline further in the show as well. But for now, they've remained very well supported for this time of the year, as you can see on this next chart over here. That's the front month EBOB crack. EBOB is European gasoline, and levels are, well, that's the white lines 2025, and levels are very comfortably above previous years for this time of the year. So wintertime normally sees a decline in gasoline as demand is a lot lower than compared to the summer when everyone's out driving. But that's just not the case this year. Everyone's buying at these really high levels. We initially saw some flurries of bearishness in the physical ARA, that's the Amsterdam, Rotterdam, Antwerp barges, that's the physical European gasoline window, but that also got bought into, and there seems to be good buying flow at this level.
All right, thanks for that, Meeta. Giovanni, let's move on now, if we may, and talk a little more about the futures market. Have there been any interesting changes in positioning recently?
Oh, yes, they have. So over the past few weeks, we've definitely had some interesting stories to tell in positioning. But before we start, let me just say about the CFTC data. So obviously, the CFTC data, we've only been able to see the ICE data, so only European data. All of the US-related data, we've not been able to see any of that because of the government shutdown. So hopefully within the next few weeks, as the government reopens, we should start seeing other futures positioning as per the CFTC. Now, if we take a look at this chart, we can actually see what's happened, at least in the Brent complex position-wise. So we see on the 21st of October, when we had this huge glut narrative, there was a lot of short positioning, especially in the money managed positions. And then at the week immediately after, the one on 28th of October, that is when Trump announced further sanctions on Russia, and we saw a lot of these short positions get stopped out. This week, we've just seen the shorts just like go back to return to normal levels after they were quite stopped out last week. Same goes for producer merchant, where we just about see open interest reduce, and we can quite clearly see in both the long and short position reducing here. Overall, open interest fell about 2% over the week, but it still remains 30% above the 5-year average and 8% above the 5-year max. Now, if we look at the next chart, we can have a look at gas oil, which has also had a bit of change in positioning as well. We've seen mainly the longs have increased. Overall, both long and short position have increased, but overall it's just been long as gas oil market has been quite bullish recently, and this positioning chart here just basically tells us that people just contribute to this bullish momentum in gas oil.
And Giovanni, we know that official COT data, of course, lagged by a week, isn't it? So what does Flux's timelier positioning data, I'm feeling, tell us? What does it tell us?
So basically, now if we have a look at our chart, the CTA chart, this is our proprietary CTA model. We can have a look at how all the various futures are positioned. And again, same as with the past few weeks, we've just been seeing how heating oil and gas oil, these are the orange and purple lines in this chart, are quite severely overpositioned. So last week we'd already started talking about how, because they're so overpositioned, they're literally in the danger zone here in the red area. We were talking about how they could, there's a high likelihood of them mean reverting down. And we looked at it quite interestingly in the gas oil crack. So the gas oil versus Brent was the widest it's ever been, and we were expecting them to revert down. However, we've just seen quite the opposite of just gas oil continuing this trend in the danger zone, and Brent, on the other hand, has just like had a tiny bit of a dip position-wise, as we've even highlighted in some of the previous charts. But yeah, I'm a bit cautious to say that we're going to see mean reversal. I'm not going to say it until we start seeing any of either the gas oil, the heating oil start approaching the lower end of this danger zone.
There you go, great insight. Let's shift focus now then to the oil swaps market and Flux's very own commitment of traders data. Has there been a recent contract that's, for you, Mita, stood out?
Yes, so the gasoline market has in its entirety stood out for me, but I'm going to concentrate on the transatlantic ARB, so that is the M1 transatlantic gasoline ARB, which reflects the flow of gasoline from Northwest Europe into the US. So this ARB, for the purposes of people watching our show for the first time, is RBOB gasoline, that is US gasoline, minus EBOB gasoline, European gasoline. And as you can see over here on our chart, this is currently for the specific DEC 25, so it's, and the seasonal chart compares it to previous years for the DEC contract. It's currently at its lowest level. So the TA ARB has been incredibly weak since the start of September, and this has been alongside a strengthening EBOB complex pressuring the ARB down. And the EBOB complex remains relentless. We continue to see sell-side interest in the ARB as a result. We briefly saw support in the contract in the ARB, that is, towards the end of October into November. This was around the time we saw refinery outages in the US, which strengthened RBOB relatively more than EBOB. And then at this time, our data showed open interest increase in the contract, and trade houses came in and started selling the ARB, defending their positions, which I assume would also be a good way to enter long EBOB, considering the rise in open interest in EBOB. It might be a safer way for them to get long EBOB, which is interesting. However, if you look at this next chart over here, we now see open interest declining. With prices coming off, this could be due to long players taking off their positions, not to cut their losses. That's fairly exciting.
So how then is the market position now, would you say? What's your view on this contract based on this?
So as I said, trade houses remain good sellers against Onyx, and refiners as well, as you can see on this next chart over here. So as you can see over here, trade houses and refiners have been selling. Refiners likely hedge positions, since selling the ARB reflects their physical exposure to the route. We saw trade houses briefly trim some of their positions this week, as you can see. But on 11th November, we saw them add to their shorts again. If you go over to the next chart, we see good selling down the curve as well. That's red being short positions against Onyx. That down the curve, we just see good selling, especially in the Q2 region, where we have seen nearly 1.2 million barrels of trade house and refiner selling. The Q2 ARB, that is the second quarter of 2026 ARB, is currently around 50 cents per gallon. We could still see selling at these levels. The ARB is fairly wide open.
Just taking a break then from positioning data, shall we dive into another really interesting way of analysing the market through the means of technical analysis, which uses statistical trends, doesn't it, gathered from past data to derive insights from the market? Mita, could you just talk us through any interesting shifts in the market, technically speaking?
Yes, I can. So we're going to start with Brent futures. So in Brent futures over here, and this week in our Brent forecast, we predicted a breakout in the futures contract after it had been oscillating around those two white lines that you see on our chart here. So those two white lines, that downward trend channel reflects a consolidation that often is a setup for a breakout in either direction. So the gap up that we saw in the futures market before that is what technical analysts, coupled with the downward channel, is what we call a flag. So it's like a flagpole and then the flag right there. And the flag represents a pause in the trend, and it's meant to signal that this trend is going to continue. So the flagpole is going to continue on the other side of the flag. So it's a nice little image for you. But right now we did see that breakout yesterday. We see that bullish candlestick piercing through that buy channel, but that has been capped by a very significant resistance level. That is the blue line on my chart, the 50-day moving average. So now the 50-day moving average has been fairly important in previous, if you look at the chart in previous levels as well, around the start of October. Momentum is still positive. That's shown by the second panel on that chart over there. It's still in the green, but it is fairly stagnant this week. Considering the momentum is still positive, it could be interesting to see if levels hold up. If not, if the 50-day moving average continues to be important resistance, we could see support around those two white lines, with further support around the $60. That's a very significant support around the $60 handle.
And you wanted to take us through gas oil?
Yes, gas oil as well. So the next chart shows the same thing for gas oil, the gas oil swap crack. This is the rolling month gas oil swap crack. As Giovanni and I have mentioned, there is a lot of bullishness in this contract, and it has pierced through previous highs this year. The second panel over there shows momentum, very much in the green, but that pink line over there currently at around 35. So when that pink line's above 20, that shows a strong trend in the market. So with the green line, with momentum being positive and that pink line being at 35, we see a strong bullish trend in the market. However, it is interesting that we see key resistance at the 38.2% Fibonacci retracement level from 2022's high above $60 and low of below $14 at the end of April 2023. $34 is also an important resistance level from 2024. So these levels will be really important to watch for the market. Support from here, should we go lower, would be at $30 and at $28 based on recent lows. The RSI, which is the third panel on that chart, has failed to make a higher high despite prices breaking to a higher high, which is a bearish divergence. Another thing to keep an eye on. Momentum is still fairly positive, and it's usually not advised to go against that in technical analysis, but the RSI waning compared to price is definitely a pretty bad flag.
Thanks, both of you. We've learnt so much already in our latest session. Now, though, I'm just going to put you both on the spot because it is our crystal ball prediction moment. I love it. So where do you see them, particularly Brent, going in the coming week? And give us, too, your top trade tip.
Well, in terms of Brent, I can't really see it breaking further than this 60-65 level. I think there's plenty of support around the 63 to 64.50, which we've been seeing all week. So I'm just going to be, in my opinion, Brent is going to stay within this level. I can't really see it going further above or even dipping below 60 anytime soon. So my prediction is around this. How about you, Mita?
Giovanni's taken the technical view. It's going to not go above that blue line, not go below that white line. But I do see his point. I do see it difficult for Brent to break above 65, 66, especially over here. I find it interesting that the IEA came out with this whole oil demand will continue to increase, and Brent spreads have not really reacted. There is meant to be a lot of hope from the US shutdown potentially ending. We don't even know if that's going to happen this week or the week after. We don't know anything about that yet. And we already have seen a good deal of geopolitical risk being priced in, and it feels a lot like we've made our move. I don't really see it going further up unless we see Trump saying something completely ridiculous by the end of this week. So I do agree that I think we've reached a bit of a cap, and we could maybe go down to 63.
We've got a last couple of charts, haven't we?
As you mentioned, our top trade tip for the week. Our trade idea in this week's Alpha report, which was on Monday, was to buy the prompt DFL roll, and I find it still really interesting, so I'm going to talk about that. So Brent spreads have seen a large correction recently, giving up most of their post-sanctions gains, as I've just said, in our crystal ball moment. So traders have turned towards the largely anticipated oil supply glut. The front Jan-Feb futures fell significantly this week, while the prompt dated rolls in November have been in contango. Contango being that the spot market is a lot cheaper than the futures market. However, we are a lot more optimistic towards December structure in dated Brent, given supportive crude fundamentals in the near term. TD25 freight, that is the freight route from US Gulf to ARA, is fairly elevated, which may reduce the amount of WTI landing in Europe, which could be a good supply side factor for some strength in December. In addition, refinery margin strength remains a bullish factor. If profit margins are fairly high for refiners, they are going to want more crude, especially in the winter. I think the winter time is also important because we've had so much discussion of refinery outages. I feel like I've said that word like 10 times in this show, but that's we should start seeing refineries come out of maintenance around December. So that should be interesting to keep an eye out, like what that means for crude demand. December rolls, as I mentioned, remain in backwardation, and with 8 to 12 December onwards, noting refiner and trade house buying. Although prices have been trending lower, we have seen them hit a floor, as you can see over here, and around the 10 cents level and go up, and they're currently around the 20 cent level. We see a little more upside from here. We're targeting around the 30 cent region, but we do recommend keeping a tight stop loss at this level.
Thank you very much. And that is it for this week's Flux Insight show. I hope you've enjoyed it and learned a lot. I certainly have. Huge thanks, of course, now to our fabulous research team, Mita and Giovanni. Thank you. And remember, for a deeper dive into our research and data offerings, you can visit flux.live, and feel free, of course, as well, to reach out to us with any questions and comments. So, see you all next time.
Hello and welcome to the latest episode of The Hedging Show. I'm joined as ever by Harry, and we've got Julian back with us this week.
Aren't you lucky?
So, this week, slight change of tack. So rather than talking about energy, we're going to be talking about FX risk, how you can hedge it, how you can measure it, how you can manage it. So I guess it's a sort of feature of many businesses, but it's not always a risk that people are necessarily aware of, or possibly one that sometimes people just think, okay, we'll just live with this risk because we can't really do loads about it. And I say when we're talking about FX risk, we probably most of the time mean exposure to the US dollar. So if your costs are in one currency and your revenues are in another currency, and that's particularly important in the commodities industry because almost all commodities are priced in dollars. Mm-hmm. And I suppose, we've all probably become more aware of currency strength in recent years, post-Brexit, as the pound has declined, we've noticed holidays becoming more expensive and, goods becoming more expensive because we import most of our inflation. But that's probably, been a fairly long-term trend over the last 20 years or so that the pound has been weakening. But I mean, at the start of this year, though, we have seen a little bit of strength. So I think, into the back end of last year, the pound was particularly weak. And then the start of 2025, we saw a sort of, 15-cent rally. And then ever since the kind of tariff news in April, we've been kind of moving fairly sort of sideways between a range of about 130 and 135. But I think that's certainly been one of the big themes of 2025, hasn't it? The kind of, de-dollarization and people not being so happy having exposure to the US dollar, which has traditionally been viewed as a safe haven.
Yeah. Just before we go on to that, there was something that you said at the start, which might be worth clarifying for the viewers. You said we import most of our inflation. Might worth clarifying.
Yeah, so that's right. So but because so many commodities, so the kind of raw inputs for whether it's food, whether it's energy prices, are all priced in dollars, it means that if the pound is weak, then the cost of those goods goes up. And because we're a net importer of food, we're a net importer of energy, we don't really have much control over the costs of those. And then the currency adds an additional dimension to that. So people in the US would have found themselves more insulated from the cost of living crisis, even though it's still being quite a big political football that's being kicked about. They would have been way more insulated from the kind of post-COVID, post-2022 cost of living crisis, because they use the US dollar, and the dollar was strengthening throughout that period. And they've also got a lot of domestic production of food and energy. Whereas for the UK, it was a double whammy because the raw prices were going up, but the sterling adjusted prices were going up even more.
Yeah. Okay. Yeah, so de-dollarizing. Well, and I guess specifically in the energy markets, you've seen like a real, since the kind of Western sanctions started in the last few years against Russia, especially, there's been like an enormous narrative of this, like, well, again, de-dollarization, but a lot of global trade, especially in the East, kind of happening outside the Western financial system.
So worth noting as well that whenever you do a transaction in dollars, it always has to be routed back via the US. So if Iran wants to do a deal with Russia or China or something like that, they can't really do it in dollars. It has to, otherwise it will be routed via the US, and they'll be made aware of it.
Exactly. Yeah. So I actually got sent an article this morning, which was from a couple of weeks, in fact, maybe like a week ago. And it was the Russian finance minister said that like over 99% of their bilateral trade with China is now priced in rubles or yuan. And yeah, I mean, you've seen, there's been a lot of articles. I mean, people who follow kind of financial news and especially in the energy markets would have seen that like more and more you're seeing like India Indonesia, Brazil are transacting a lot with Russia and China in actually their native currencies, which, as I understand it, is quite a big boost for them, not having to kind of hold like large reserves of US dollars to transact and being able to just transact in their kind of domestic currency.
Yeah, no, I think that's huge, isn't it? Especially with all the kind of tariff disruption as well.
Yeah.
So I think historically it was probably less of a problem because all of those kind of Southeast Asian countries are sort of exporters, and they would have probably been running a dollar surplus.
Yeah.
So it probably wasn't a massive issue for them to then use those dollars to buy energy. But since Trump's effectively trying to reset that balance, they don't necessarily have so many dollars swishing around anymore.
And also, well, it's on one hand they get the oil's discounted anyway because Russia is just selling discounted oil because they need to keep it moving, but also being able to pay for it in your local currency as well and kind of circumnavigate the Western financial system for them, it makes it like much more efficient. It's a big boost to the economy, basically buying cheap oil in your own currency, where they used to kind of have to go to the kind of open market and buy it in USD.
Yeah.
And also, if you're buying a lot of stuff from China, which most people are, if you can now kind of transact in energy in yuan as well, then it almost kind of makes more sense now that you hold just a big foreign reserve of Chinese yuan rather than US dollars.
Yeah, exactly. And then you kind of have to look at where you're investing those foreign reserves as well. I mean, kind of historically, people were quite happy to hold dollars as their main reserve currency, weren't they? Because, you could just plow that into US treasuries and that was seen as the kind of ultimate risk-free asset. Whereas now with the kind of constant hiking of the debt ceiling and the kind of US government borrowing just going up and up and up, people are a bit nervous about holding US treasuries, and they'd probably be more comfortable holding Chinese bonds now, I would say.
And I think I pulled a stat for this, which was that the kind of foreign US treasuries held in custody, I think, is at the lowest level for like 15 years or
we
something.
should get a graph of that up because that's a really, and if you're selling those off, you're actually adding to US inflation, right? Interest rates are going up, their debt is increasing. It really is exponentially compounding. It's kind of similar problem we've got here in the UK.
Exactly, with gilts where you've got quantitative tightening going on.
Yes,
that's pushing yields higher. And then you've also got sort of lack of demand as well, which is just it's a bit of a perfect storm, isn't it? But yeah,
and it's interesting, isn't it? Because this is not about Donald Trump and the US sort of policies, but of course he's very keen for interest rates to go down, as we are here in the UK too, because public finances are out of control, right? And that hopefully that's going to get addressed shortly. But that it's really conflicting, and that lack of stability really is problematic now, isn't it? It really is.
And I think we should probably even do a whole other show about interest rate hedging.
Absolutely.
before we sort of fall down that rabbit hole.
Yeah, let's come out of that rabbit hole.
But yeah, I guess sort of in summary, it's been a major theme of this year, hasn't it?
Yes.
The kind of de-dollarization, weak US dollar generally, people looking to diversify away from the US, whether that's kind of rotating out of kind of tech stocks because there's a high valuations, not wanting to hold US treasuries, and obviously we've seen massive flows into gold. But obviously we kind of need to be cognizant that if you are investing in something like gold as a hedge against the US dollar, if that hedge itself is denominated in USD because it's an ETF, or if it's a gold future trading on COMEX or whatever, then you've still got that dollar exposure, and that's potentially going to water down your returns. But I think we'll go on to that in a little bit, where we've kind of got an example that illustrates that.
But yeah, just I suppose to summarize how it's in the energy markets, I think out of all kind of asset classes, energy's been where most of this, and oil specifically, has been where most of this kind of de-dollarization has been pronounced, especially because Russia's such a massive exporter of oil, and the East is kind of starting to transact in native currencies. That's been like an enormous theme, and like India joining in as well, like huge refining sector, them all kind of being willing to transact outside the US dollar system is like, it's a huge shift. It's like a real tectonic shift. And you kind of, I think Donald Trump's quite nervous about it, given he's kind of just constantly threatening new tariffs on, people for not using US dollars. And
yeah, it's always been in the background, isn't it? I mean, I don't think dollar supremacy is about to end.
No.
Overnight, but it's definitely at risk, isn't it?
Yeah, it is.
And there's always been a keenness to move away. And maybe now this is the impetus to accelerate that,
Which I guess is what they're worried about, right? It's a bit of a house of cards situation where it kind of looks like the start might be quite slow, but then all of a sudden, if people don't see it as a kind of the safe haven it once was, then it can be quite exponential how it all unravels.
Yeah. You get into this sort of like doom loop, don't you?
Yeah.
I mean, I remember even sort of like 20 years ago, people were talking about the euro challenging the dollar's dominance, and then the kind of sort of post 2008 sovereign debt crisis kind of put pay to that, and it's probably only just kind of coming back now to the kind of safe haven status that's starting to look attractive again versus the US dollar. But I think that narrative is more about dollar weakness than kind of euro strength, isn't it?
I mean, the reality of the consumer market in the US is just so huge, isn't it? It really is. So I can't see it ending personally. It's just it seems to have started a slippery slope, but maybe that changes, right? And let's not forget Western politics is always quite short-termist, isn't it? So it could all change in 3 years' time, right?
Yeah, I think that's a good point actually, because I think it's worth noting that people from all around the world invest in the US, whether that's holding US stocks or US bonds.
They really do. Yes.
US people only invest in US assets. They got no interest whatsoever in owning kind of European stocks, foreign government bonds. They it's just not on their radar. Full
And if you
stop.
think about it this year, just again, not really related to what we were supposed to talk about, but the S&P return has been phenomenal this year, hasn't it? Which
You
probably suggests there's a massive
Julian.
correction. Sorry. Yeah.
But anyway, so I think that's a kind of good sort of geopolitical overview, and we've kind of highlighting the fact that there is FX risk out there. There's the chance that you will get significant moves, but it's all about risk tolerance, really. Some people, to some firms, a 10-cent move could be manageable. For others, a 1-cent move could be problematic. Going back to what we've discussed in previous shows, it's all about your margins, isn't it? And if they're wafer thin, then you're more sensitive. So I guess kind of going back to the topic of hedging, it's if you're a company or you're an individual even, it's first of all, are you aware that you even have this FX risk? And then where does that come from? It's we talked about this before. Just because you don't have a physical position that you can see, it doesn't mean that you don't have exposure, right? So going back, I think Onyx as a company is quite a good example of that, because obviously all of their revenue from trading activities would be in US dollars, but most of their costs would be in pounds. So that just gives them a natural short position in cable, because they're effectively long dollars and short pounds all of the time. And then how do you then kind of construct a hedge around that? Because some of those things might be quite easy to measure. Probably your cost base is probably quite stable and predictable, but your revenues might be a lot more volatile. And then also, you've got to think about, are you hedging against a specific timeline, whether that's, just you're hedging 12 months out, or are you hedging against a specific transaction? So you might get an example where, say a UK company wants to buy a company in Japan or something like that, so that they know that they're going to be doing a sterling yen transaction in 12 months time. So they know precisely what their yen exposure is, and they know precisely the length of time that they need to hedge. Whereas if you're a company like Onyx, for example, then you've almost got this requirement for a perpetual hedge, and the size of each leg might be kind of going up and down all the time. So it becomes a lot more.
You kind of don't really know till after the fact.
Right? Yeah.
But I think it's one of these things that
you just mentioned the word cable. I just conscious that I don't actually know where that term came from. But when you mention cable, you mean US dollar versus
that's
sterling.
an interesting point. Yes, so that's kind of the industry term for pound versus the dollar.
Yeah.
And the reason it's called cable was because the first transatlantic cable that was laid was specifically laid so that it could transmit the FX rate back and forth across the Atlantic. So yeah, that's why it's called cable. And yeah, so interesting bit of that.
Just threw you off your flow there. Sorry,
no,
Tom.
that's fine. So I think kind of going back to what we were saying though, it's even if you've got a very complex FX exposure to manage, like we were saying, where it might be kind of perpetual, it might have different size or variable size on each leg. I think the first step along that journey is just being aware that you have it, isn't it? It's just recognizing that you have a position. And then it might be that you say, okay, we're just going to, risk accept that volatility in our earnings. But I think, the second natural step is, okay, well, how do we measure that? How do we measure the impact that it's having? And then we can then make a decision to say, are we okay with that? And if not, then the third step is, okay, well, how do we kind of, mitigate the impact of that?
Calls, yeah.
And I think, we kind of touched on gold a little bit earlier, but I think that's a kind of prime example because money's been flowing into gold as a safe haven asset, but that is very tied to the value of the US dollar. I mean, it's typically priced in dollars, and as the dollar weakens, it's kind of bullish for all commodities really, because it effectively makes it cheaper for anyone who's not paying in dollars as their base currency, but you're still having to kind of convert into dollars and then purchase the asset. So you've still got some exposure. And it's worth noting that if you look at the price in gold in sterling terms versus the price in dollars terms, that rally has been far less
it's more muted, isn't it?
Yeah. And I think we'll just go on to I've got a kind of just a mock-up here illustration of how FX risk can really eat into your returns over time. So this is a fictitious company here called ABC Inc. And we've just assumed that you're a UK individual and you've purchased shares at $2 in January. And then at the time you purchased those shares, the cable rate is 1.2. And then over time, I've assumed it's gone up in a fairly straight line to almost 1.5. That's the orange line on the graph there. And then, so you can see that over time, over the course of that year, the share price in US dollars has doubled from $2 to $4. But so you've made 100% return in dollar terms. But because of that strengthening in cable, so it's basically gone up by 25% over the course of the year, that's wiped nearly a third off your GBP return. So that although you're up 100% in dollar terms, and that's those two sort of stacked bars, that the green one is your percentage return in dollars, the blue sort of turquoisey one is your return in sterling. So you can see here that effect, it's kind of completely decimated your returns really, hasn't it? And even if we look at that first bar where you can see that in February the share price has actually dipped by 10%. It's because sterling has just been constantly appreciating, it's making your losses worse and making your losses bigger and your profits smaller. So definitely something to be aware of if investing in foreign assets, that you've got that FX risk that can eat into your returns.
I think I get it. That's a really interesting slide. I think the other important thing to say there is all hedging is about trying to match your financial cash flows at the end of the day, isn't it? Which is what you're really highlighting here at the end of the day.
Yeah, and I think actually you've got quite an interesting case study, which we'll go on to in a minute. But I think I'll just probably useful at this stage to kind of highlight the kind of thinking process that we want, the kind of mindset that we want people to get into when they're kind of structuring a hedge or thinking about a hedge. And that's, okay, step one, identify your current position. Okay, step two, what's your size? Can you measure the size? Is it fixed? Is it variable? Think about the duration. Is it perpetual, or are you just hedging up to a specific point? And then, think about the instrument that you want to use for your hedging. Should you hedge in spot FX, or should you trade a forward? So I think we would always say, if you've got a long-term hedge, you should use the forward, because that's also pricing in interest rate expectations, which is something we haven't really touched upon about the kind of dynamics of FX pricing. But I guess this kind of simplest way to think about an FX rate, which is always just the relative value of one currency against another, is it's effectively the kind of share price of a country, isn't it? It's a much better reflection of people's economic assumptions about that country than maybe the stock index, which probably consists of a lot of companies that have got a very international focus. I know I've always said that the kind of FTSE 100 is a very poor reflection of the UK, because you've got lots of internationally focused firms, lots of energy firms. They're all of the main firms are dollar earners, so they're not that exposed to the UK economy. Whereas the FX rate is really kind of pricing in expectations about interest rates, which in itself you can infer the kind of state of the economy by what the interest rate is doing. But it's also moving based on kind of relative demand for imports and exports. So if the currency is strengthening, you can kind of bet that the economy is doing well, because interest rates are rising. Probably to try and kind of put the brakes on economic growth a little bit, and probably demand for your currency is going up because your exports are doing well. So that's something that's worth bearing in mind. And if you're just hedging in the spot market, you've got exposure to if assumptions about interest rates change, you've got exposure to that in the same way that you don't if you're trading the forward.
So really the difference there on your sort of third point, that duration piece, if you're going on holiday, you're going to make an exchange rate, you could do it now or then. It's when that payment date's actually due, but sometimes you don't always know that, right? So you might use a perpetual process. I think your last point here, beyond your execution piece, is really important. We should just say, this is all kind of wrapped in the game plan, is the policy, that what the company internally is comfortable taking a risk, as you were saying earlier, and has it got the money to fund that hedge should it go really negative against the market, which we'll come back to in a minute.
Exactly. So execute the plan and then stick to the plan. But before you execute, make sure you're actually
is sensible.
Make sure you're able to stick to it. So it's worth bearing in mind that as we always say, your hedge can go massively offside, but that shouldn't theoretically matter, because it should be a zero-sum game, right? Where whatever you're losing on your hedge, you're making on the other side. But as long as you can kind of account for that in your P&L, and also just make sure that you don't have some kind of liquidity mismatch where you're kind of having to fund the losses on the hedge in real time, but the revenue from the other side isn't going to be realized for a year's time. So it's worth it's always worth highlighting that. Make sure that you can afford to fund the losses on the hedge, and that's why I guess options are quite an attractive proposition, which is the kind of third type of product you might want to use. So you've got kind of spot FX, forward FX, but you could choose to buy an option, and you're probably not going to use that as a sort of direct hedge to kind of lock in the full value. You're probably using that to kind of as a defense mechanism against a kind of catastrophic move. So you're probably buying an option that's out the money, and then that kind of kicks in in the event of a significant move. But obviously the advantage of using a call option or a put option is you're just paying for that premium.
Your cost base is quite
your cost of hedging is defined.
Your cost base is very well defined.
Yeah. Okay. Which kind of brings us neatly on actually to the case study that you were alluding to, Julian, where their company didn't do that very well.
Absolutely. I mean, there's a whole raft of examples, Metcalfe, Shaft, Enron, so on and so forth. But this one, South African Airways, back in 2003, really interesting one. Wasn't directly involved in this, just researched this for this show. And obviously it's particularly relevant because international, flag-carrying airlines, a lot of low-cost carriers in the past have on and off hedged different risks, including FX, including oil risk, right? So it's a really pertinent sort of example. And let's just think of the first couple of things here. They absolutely, in 2003, they had just committed to buy 41 Airbuses over a period of 10 years. And so they're going to be paying these off over 10 years. And they might have been renting them, but essentially giving themselves a large exposure to US dollar payments over 10 years. And of course, South African Airways are their sort of core currency, internationally flying, but their core currency is Rand, South African Rand or ZAR. So they've got this risk to dollar, and if the dollar was going to strengthen, this would effectively push their costs up dramatically for these 41 Airbuses that were due to be delivered.
It's worth highlighting as well that the Rand is an emerging market currency,
really
and
is.
it is the volatility compared to something like cable or euro dollar is off the chart.
It is much more extreme, isn't it?
Yeah.
2, 3, 4-fold, right? Yeah, you're absolutely right, because actually those major currencies, the volatility tends to be relatively muted, right? 10% there or thereabouts, maybe varies, right? So actually, someone in South African Airways, don't know who, I guess someone in the Treasury team, read some bank research saying the dollar's going to strengthen. So they said, right, okay, let's put a hedge on for the 10 years. So as I understand it, wasn't there, don't know the full details. They went off and bought this dollar Rand hedge for 10 years forward. So firstly, that's a very long-term hedge, very, very long-term. Most budgeting for companies, PLCs, South African Airways wasn't a PLC then, is normally a year, maybe 2 years.
Yeah.
So 10-year hedge is a long time.
It's a hell of a long time, because even that's probably normally what you'd expect to be like an entire economic cycle. So if there's a downturn in that time, you might decide actually we don't want 41 new planes anymore, right?
Or simply the company may not be operating in 10 years' time, right? So the hedging it might be, it's a very long window. However, just in the context of buying those Airbuses, that's a 10-year. So, we are talking about actually an aligned hedge here, right? So important that the hedge, the process that hedge was going to do what it's meant to do, right? Effectively. Now, what actually happened, contrary to the bank research they read, actually the dollar weakened by 28%. Versus the Rand, as you were saying, right? So in 2023, literally within a few months of putting this hedge on, it had completely gone the other way. So this hedge is now deeply out of the money, creating a massive negative cash flow for them. Now, the hedge is theoretically operating well, but actually they've run past their credit lines and had a 6 billion Rand mark-to-market loss. Almost $1 billion. That's a lot of money for any airline, any company, right? It's a lot of money to have that impact and find that cash when I actually haven't got these airlines operating yet. These airplanes in my portfolio operating, generating cash, right? So we're really offside. So the key things there, if we just break that down, just really want to remind people, the hedge is actually a reasonable hedge. What appears not to have gone on is they've acted on impulse. On this bank research, the bank's going to be right. Let's hedge, and so that's a first big risk. And it appears, having read about this, that there was no internal risk analysis. If we do this hedge, what's the cash flow impact? What happens? What if the market goes down 50%, 60%, 100%? Those real disaster scenarios, unlikely to happen, but let's just plan that out. Could we afford it? So that didn't happen. It's a very long-term rigid instrument. So to your point earlier, no, there's no linear. This is completely linear. They completely fixed everything. They didn't do 10%, 20% layer in slowly. They which was sort of replicating an option or buy an option for that period, which would have been very expensive, of course.
True.
They wouldn't have wanted to have done it when they looked at it, I suspect. But they got this long-term rigid. I'm completely hedged in one go because the day is the day, which is often not the case.
And I think that's. I think that's a very good point, isn't it? If you're ever thinking that you need to execute a hedge with that much urgency, I think that sounds like kind of FOMO.
Stand back, stand back for a second.
But I think that's always great advice. If you're new to hedging, then just dip your toe into the water. You don't actually have to hedge the full size, in one fell swoop. Just
And most don't.
Exactly. You know,
Yeah.
we even talked about Ryanair, who've got a very well-established, very successful hedging policy.
Yes.
Even they're only doing sort of 80 to 70 to 90%,
They've
or
done
something
it all
like
in
that.
one day.
Yeah.
Exactly.
They
So
layer in.
dip your toe in. At least at least that's going to have some mitigating
Yes.
impact, and you can see the effect of it on your cash flow. See whether it's kind of fit for purpose, and then just constantly reevaluate. Okay, is this
Yes.
working? If yes, okay, well, maybe we're comfortable increasing the size. If not, maybe we need to, change our approach.
And I'm sure those companies are mark to marketing and saying, well, what if it goes down? Are my cash reserves enough to fund, beyond my credit line? If I go beyond my credit line, can I withstand a shock on my hedge to be able to pay for it? So what really appears here, and you, at the bottom of your list, you had here that there was actually no defined hedging policy. And in my experience of 20, 25 years in this market, I am staggered how many companies I have worked with in the past that don't have a clear defined hedging policy. Really important. What is my internal business risk? What are my internal business limitations? Can I fund this hedge? And I've worked for companies where the CFO has called and said, whatever you guys are doing, stop, because we can't fund it anymore. And that's not because we're outside of policy. It's just the left hand and right hand weren't necessarily linked, right? And people weren't monitoring things the way they should be. So it really is a real risk, a ubiquitous risk. So internal controls, is this hedge fit for purpose for my company's limitations? Really important.
Great. Well, yeah, a lot to unpack there, and I think we can probably revisit that in future episodes for sure. But I think that's about all for this week. But thanks once again for joining us, and we look forward to speaking again soon for another episode of the Hedging Show.
Cool. Nice one.
Oh, thank you.
Thank you.
Hello, welcome. This is the first and the only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar. It's all here in the next 30 minutes. Welcome to the UK Energy Show. So, this week we're talking about COP. COP30 got underway in Brazil with a clarion call from the hosts. We need roadmaps, they say, which will enable humankind in a fair and planned manner to overcome its dependence on fossil fuels, halt and reverse deforestation, and mobilize resources to achieve those goals. We'll discuss what's been discussed in Brazil so far. Also this week, diesel prices are on the rise again, particularly at the pump in your town. Why should that be when the world has a glut of crude oil? And never mind the future, wind power has already saved the UK over £100 billion. We hear from a former market trader turned academic. That's all a bit later on. Joining me to discuss this week's events, Julian Keats from the Flux markets. Julian, welcome to you. Let's get into some of the news of the week, shall we? COP30. Now, COP30 is the United Nations Climate Change Conference. It takes place in Brazil from the 10th to the 21st of November this year. These climate change conferences take place every year. They're the world's only multilateral decision-making forum on climate change that brings together almost every country on Earth.
And it's great to have the head of state so committed with this COP. And I believe this was a really wonderful opening session. Then I have to thank here in front of all of you, all the delegations for the fantastic agreement that they reached regarding the agenda yesterday night, late at night. And this agreement is, I believe, going not only to allow us to start working today already very intensively, but it will also allow us to explain to the world why these additional issues that have been raised really matter.
That's a clip from the opening press conference. So, Julian, let's talk about COP. Let's go back.
Yeah.
What are they all about?
Yeah, I think that's a really important place to start. So just think COP30, as it's often referred to, COP29 last year. It's the 30th annual United Nations Climate Change Conference, and it's taking place, as you said, it started on Monday and it runs all the way through to the 21st of November. So roughly 2 weeks. And it typically, right at the end, it doesn't always end on the date that they think it's going to end, because there's a bit of wrangling and gerrymandering and deciding actually what's going to be achieved and announced. So on and around the 21st of this month, and as you say, Belém, which of course is the gateway to the Amazon. So this year, hosted in Brazil, and I'm sure they've chosen that site for a specific reason, deforestation, so on and so forth. So this global summit brings together nearly 195 countries, the world's countries together. Okay, collectively, they're going to negotiate and advance climate action, aiming to limit global warming and adapt to climate impacts, whatever might be happening. And of course, this just in the last few weeks, we've had Jamaica, the hurricane there, the strongest hurricane ever landing in the Atlantic basin. Okay, so again, climate activists would say that's absolutely down to climate change. The Conference of Parties, COP, Conference of Parties, is the main decision-making body, okay, for the UN framework of Convention on Climate Change, UNFCCC, which was established back in 1992. So it's been running for a long, long time, and they created a global framework to address climate change and impacts. So COP30 builds on 30 years of climate negotiations, including landmark agreements like the 1997 Kyoto Protocol, which had some real issues in being able to allow countries to agree, because it was a more draconian approach. You will do this. So actually, the Paris Agreement that's often referred to, 2015, COP21, I think it was, that decided that actually we would lead this on an individual country basis, NDCs, and allow countries to decide what they're going to do. And actually celebrate the UK. The UK really embraced that, in actual fact, and has led the charge. I believe. Okay, so that's a really positive thing for the UK. We should congratulate ourselves about that. And what's this all about, the Paris Agreement specifically? It's about limiting, and you can see on the screen here, limiting climate change from pre-industrial levels. That's 1850 to 1900. Climate change annual temperature changes to 1.5 degrees to 2 degrees, somewhere between that range. And as you can see on the chart here, and we'll play it over the course as we're discussing COP30 here, at the moment, we really are threatening 1.5 to 2 degrees. And this is, the limit is due, that maximum limit is due by 2030. We want to limit climate change below 2 degrees come 2030.
But that ambition, which was set, as you said, and reiterated many times, looks like it's going to miss the target. As a globe, we're going to miss the target.
Yeah, some people say, because it's a 10-year average, so we're not 10 years beyond, of course. So and climate change, we have spikes and in terms of temperature and reductions as well, as predicted by climate change scientists. So we're not really there to say, undeniably, we have breached it, but it does look like last year was the warmest year on record. So what are we going to do about it? That's the key thing, really.
Yeah. What are you hearing from your colleagues and in the market generally about the Americans not being there? I mean, we know Donald Trump is a climate, if not a denier. He's not a fan of climate change. Absolutely. He doesn't really believe in it. He's not sending a delegation. Does that really matter?
I think it does send a signal to people that are in that camp. I can understand why we've really benefited, and we'll hear from Colm O'Shea later, right? We've really benefited from what I call low rent energy. Very, very relatively cheap energy, right? And the reality is that that should we want to reduce our emissions, we need to build different infrastructure, and that has a cost to it, of course. So with Donald Trump not being there, actually the US Senator for California, Gary Newsom, is at Berlin.
And he's very concerned.
And he's very concerned, of course. Yeah. And of course, he's making a political statement, of course, by doing this. And I personally believe we're in a transition, right? So we need to think about both. We need to be sensible with our policy, and we'll hear this from Colm O'Shea as well. We need to be really sensible how we enact and transition, because policy, as we're going to see, as we discussed today, really does impact the price. And this is all about, this show's about affordability. So we really want to do things in a sensible way, because actually, when we see that spiral on the screen just now, it's really intangible, isn't it? Okay, if I was in Jamaica, it wouldn't be intangible.
We can acknowledge it. It's knowing what to do.
Yes.
Isn't it? Okay.
Yes.
Let me bring you right to our second talking point this week, which is here in the UK, as we record this show, we're still 2 weeks out from our budget.
Yeah.
But I've never known a budget with more speculation about what a chancellor will or will not do. What's the buzz around energy and what it's going to cost you and me as consumers? Are you hearing anything?
Yeah, absolutely. And we've got on screen here the FT's response or prediction that Rachel Reeves is going to very seriously look at bringing energy bills down. And again, I think it's very important. Energy bills at the moment, the tariff, the price cap for energy bills is around about £1,700 per annum for electricity and heating for a standard 3-bedroom house in this country. That is almost double what it was 15, 20 years ago. That really is important. It's politically important. It's important for individuals. It's unaffordable. So,
and a portion of that is tax, right? Which is her thing. So she does have a lever she can pull. Make it worse, make it better.
Yep, absolutely.
By a measure.
Absolutely. And I think...
What's your sense, Julian?
My
is she going to
sense,
do it or not?
I think she will cut back VAT, because Labour's big mandate is to run the renewables, because long term it should be cheaper, but in the near term we've seen costs come in to the bill. So VAT, I think, will be reduced. And I think green levies will be reduced. And if we think about VAT on that £1,700, that's about £90 a year, right? So that's not insignificant. And then the green levies are around about £170 a year. So those two things combined, if she was to reduce them completely, and we're speculating here, that's £250. So we bring that price cap down effectively to £1,500 a year. So it's a substantial decrease, but it's not back to where we were 15 years ago. Okay.
Let's talk about diesel prices, shall we? Because right now, diesel prices are going higher at the pumps. I don't know if you've noticed, because they creep up, don't they, by a penny or two a week. Why is that going on? I thought there's lots of crude lying around the world.
Right, yeah, that's a really good question. So actually, as part of answering your question, let me just draw watchers, listeners to the slide we've got on the screen here. This is freely available on our website, and you can track your diesel prices and gasoline prices here in the UK at the pump price. And prices last week, the average price was £1.43 at the pump. On average, varies depending which pump you're going to, where you are in the United Kingdom, but on average, £1.43. At the moment, spot markets are around about £1.48 equivalent right now. And that price rise has been driven by a couple of things, I think. And it's always difficult to be absolutely definitive, but I think we're coming into winter. Winter is predicted to be very cold in the Northern Hemisphere this year.
Blame the meteorologists for that.
Yeah, we're going to blame the meteorologists for that. And you might also say, well, hang on a moment, you're just talking about global warming. Cold. But actually, global warming predicts that we'll have extreme changes as well as a trend upwards. Okay, so we're predicted to have a very cold winter this year. Who knows whether it will do, but that's had an impact to diesel prices, heating oil prices, because they're kind of very similar products. And the other key thing that we talked about last week and the week before, was the sanctions from the United States on Lukoil and Russia. And I think Greg was mentioning that's could be huge. And we're really seeing an impact on the cost of taking crude, refining that into diesel. And Lukoil has refineries in Eastern Europe, and those refineries currently aren't really selling anything. So you're finding that impact come through on diesel, and that's impacting on our diesel price here in the United Kingdom.
So
That's
the
what's
lever
really
that's
driving.
working there is the Trump sanctions, is it?
And
It's
they are-
affecting Lukoil, and
Yep.
that's affecting everyone.
And ostensibly they are impacting. If they are affecting this price, and it's a part of the price, I haven't said how much it is, I don't know.
Sure.
But it absolutely
These things have a
underlies
ripple effect, don't
ripple
they?
effect.
Around the globe.
And what we want to add in, and Greg was saying two weeks ago, if these sanctions are really policed throughout the supply chain, and they're difficult to police that way, let's just balance that argument out. But if they are really effective, and history says they're not, right? But if they are really effective, we would start to see crude prices as well as diesel prices really escalate in value, possibly towards the $80, $90 a barrel mark. Now, I'm not saying that's going to happen. That's if policing really happens. History says they are not policed that closely.
This is the UK Energy Show, brought to you by Flux, the news, information and trading platform for world energy markets from Onyx Capital Group. Now next, wind power has saved the UK energy consumer billions of pounds over the last decade or so by reducing the cost of energy we use by over 100 billion pounds. That is a bold claim in a new piece of research which has been co-authored by a former market trader and businessman, Colm O'Shea. Colm has recently concluded a master's degree looking at the impact of the UK's nascent wind power industry and that's had on the price of fossil fuels, in particular, the price of gas. Now, his work is presently being peer-reviewed. It does make some surprising discoveries around the ROI of existing infrastructure. So I called up Colm and asked him if he thought the financial markets had this benefit factored in.
Financial markets like electricity markets, oil markets, gas markets, they're pretty smart. I mean, those are the kind of things I use to trade, and those kind of things work things out. Where you're talking about markets, meaning, is it good to invest in a wind company that builds turbines? That's a different kind of problem, because the big problem that I'd say the renewables sector faces is that there's a massive benefit to the renewables industry that doesn't go to the people who own renewables companies. It's like the opposite of tobacco. Like tobacco companies make loads of money, and unfortunately, other people get cancer and other people pay for those healthcare costs. Wind's like that in reverse. Is the wind companies aren't making huge profits, but what they do is they prevent us paying much more than we need to in buying imported gas.
That rather turns the argument of people being against wind or against renewables, or believing that renewables are expensive and something is going to be a long way out of reach. It rather turns that argument on its head, doesn't it?
It does, but that's why I wanted to find out the answer, because I found these debates really frustrating to listen to, because what you'd have is a skeptical person talking about money, and then a person in favour generally talking about climate change. And I thought, those arguments don't reconcile. They're not talking about the same thing at all. If someone says, I think wind is really expensive, someone else should say, I agree, or I don't, and here's why. So I wanted to find that answer. And the answer I came up with, it means that it doesn't matter if you don't believe in net zero. It doesn't matter if you think climate change is a complete hoax. You still want to have wind energy because it's much cheaper than the alternative.
Yes, and we are, I think, I know it's stating perhaps an obvious point, but as an island nation on the edge of a vast ocean that's pretty windy, we are well placed to exploit this to our own advantage, aren't we?
Hugely. But I think the thing that confuses people, and probably used to confuse me, is someone of my age, gas has been cheap my entire life. So in the 1970s, you had all this cheap gas coming in from the North Sea. And so in the 1970s, we converted everyone's house to gas boilers. In the 90s, we converted all our power stations to gas because it's the cheap thing. It all comes to the North Sea. That's fantastic. And what people don't seem to realize is that we've kind of got it all now. I mean, we now extract 10% of what we used to. And that's just geology. So these are oil and gas fields in decline. We don't have that cheap energy anymore. Texas does. We don't live in Texas. So the local energy that's cheap, which used to be gas, now the local energy that's cheap is wind. And if you still want to have gas, you've got to go and get it from Texas. And that's really expensive.
And in doing your research to build up this case, this argument, you've just made the assertion that the North Sea is to all intents and purposes exhausted. What evidence did you find for that? Because you'll be aware there's still controversy over those who think we should carry on drilling because there's still more to get out of the North Sea. What's your view?
I think a lot of this debate about licenses is a total red herring. I mean, there is gas possibly like a mile down in the North Sea, but it's so expensive to get to it that no one's going to drill for it. So you can have a really hypothetical debate in an alternative reality where someone's going to drill for very expensive gas that no one's ever going to want to burn because it's ridiculously expensive. So the gas that's easy to get at, we've got it. Norway still has some. That will also decline over the next decades. We are already importing lots of gas. Without wind, we'd be importing loads more gas. And a few licenses here or there for people that aren't ever actually going to drill for it creates a lot of political heat and a lot of anger and noise. But on both sides, I think it's just irrelevant.
And the fracking or shale gas story, did you look at that?
Yeah, it's really big in Texas. Yeah, if you watch Landman, it's really important. It doesn't mean, I don't think, Doncaster's going to turn into Texas. There is a debate about it on heat on both sides, and I don't really want to express a strong opinion. I can see both points of view. What I'm really saying is it makes incredibly little difference to the cost of your gas bill and electricity bill, because best case, we're never going to get a lot of it. Gas, if there is cheap gas in the world, it's not here. And it costs an awful lot to move the gas halfway across the world.
A reflection that's probably outside the scope of your project, but if you'd like to venture a thought, please do. And that is the way the things have worked out at the moment. It is the electricity consumer that seems to be paying levy after levy after levy, making electricity more expensive to you and me in our homes. Gas prices go high enough, but then the government or the administrators of the day explain that that's because of all sorts of the gas consumptions and the point you've made about having less North Sea gas. Is it unfortunate, unfair, or just a necessary growing pain that electricity consumers are paying a heavy price just now?
I mean, it's totally counterproductive. It's policy that is contradictory. It makes absolutely no sense to pile all the taxes you can onto electricity bills, subsidize and the main thing you're doing renewables is bring down gas bills. So you have this double whammy that electricity users are paying all the costs, gas users actually get all the benefits. And the big problem is you make electricity really expensive while saying that you want to electrify the economy. If you want people to have heat pumps, make electricity cheaper. And what they're doing, they're making the bills really expensive. Those are political choices. They don't come out of the economics or the finances. There are lots of things being pushed onto people's bills just because, frankly, the government wants to raise as much tax as they can, and people have to pay their energy bills. And so it's a way to raise tax. It's not a way to build an efficient energy system.
Tom O'Shea speaking to me a little earlier. Some interesting research. As he says, it's being peer reviewed. So the exact numbers may pose up, but he's making this essential point that gas prices could have been a whole lot worse had it not been for the wind infrastructure that's gone in.
Yes, that's exactly the point he's making. And I really like his research because he's trying to factor over a long period of time, and restructuring any major product, any major sort of infrastructure change, you need to think about it over the long term.
Yeah.
And I think he's saying he's talking about geological depletion of the North Sea, that actually that is fact. We're not Texas, where we have, and there are various basins across the United States, not just Texas, where they are fracking cheap gas. That cheap gas does make its way to the United Kingdom through LNG imports.
Okay.
But LNG imports, as Colin says in his interview there with yourself, is that's extremely expensive. Actually, it kind of sets the UK gas price today. So it costs about 2.7 pence a kilowatt to bring in here equivalently. So that's exactly where gas prices are today. Right, so that actually does already happen. So we're taking cheap gas from the US and importing it from here and from Norway and also from Qatar via LNG imports, Norway via a pipeline. So that is already helping our gas network. But as he says, we've avoided having to consume that gas because to produce wind, you just need freely available wind. There is no invoice to wind once you've built the farm, right? And that's really...
And he was at pains, as I was talking to him, to point out he's not actually a campaign
No,
for either
not at
side
all.
in this. He's not pro
He's
oil.
impartial.
He's trying to be impartial as a piece of academic work. But it's interesting that maybe, and this is a sort of note to self really, as we go through this programme, that above that political noise and some real passions about the pros and cons of all this, quietly, engineers are getting on with problem solving, like how to optimise our wind in the British Isles.
Yes, and I think he makes a point. We've got a lot of abundant wind here. I think you actually raised the question, right? We're on the Atlantic. There's a big fetch.
Yeah.
Sometimes we're very windy and probably likely to continue get more and more windy. So yes, we've got that, but also we have. So he's talking exclusively about wind. And wind, if we do look at wind, offshore wind particularly, actually the current round of licensing to build new offshore wind is extremely expensive. It is more expensive than the current gas price. But will that stay the same long term?
It's one to watch for us.
It's one to watch.
And just an observation he made about policy. He was not getting political, but he was making a call to policy makers to make the right calls, wasn't he?
Yes, he was. And this is a really important factor. Actually, the real issues are in and around renewables, particularly in the power, the electricity renewable process, is that policy is a complex tapestry of sort of, we'll just tweak the policy here. And that filters down to the UK household buyer of electricity. So we've not done anything with gas to heat homes because our homes aren't efficient. We've left that alone. Everything's built on the electricity price. And so actually what really needs review is a very deep system-wide policy review that's updated for where we are today and where we want to go. Right.
Next up, let's have a look at what's been said on our social media channels from people who've been watching the UK Energy Show. We've got, Julian, some commentary on the Lukoil story, which loops back. A comment here about Bulgaria has only got 35 days of gasoline and some 50 days of diesel. That's just one country. But it is related to this whole Lukoil shortage we were alluding to earlier.
Yes, absolutely. There's a refinery that Lukoil own that Lukoil are trying to sell their international assets as a result of the US sanctions. So, of course, Bulgarians and Eastern Europe are impacted by that because if it's not being able to run, there's going to be a potential shortage of refined product. And, this just highlights how important refining and oil is to running economies, travelling. It lubricates economies. It's so vastly critical in terms of the energy transition, in terms of mobilisation, in terms of running an economy. So yeah, I can understand their worry. What I would say in response to that is, in my experience of 35 years in the oil market, it is incredibly good at adapting. So price changes and that brings in the required. Unfortunately, that will have an affordability impact.
Okay, let's just get your take on this next post here, which is from Claire Coutinho, who happens to be, as I'm sure you know, the Conservatives' lead spokesperson, the Shadow Secretary of State for Energy. Here she is having a pop at Ed Miliband. Now he's going to lock us into higher prices for decades. She's joining a Cut My Bills campaign, the political knockabout, which we were remarking earlier in the show is not particularly helpful, continues. Inevitable, I guess.
And let's face it, it is politically sensitive. It is sensitive to UK households, 30 million households in this country, hugely important. The two things I'd really say about that is that the FT article we were looking at earlier, if it is right in its speculation that Rachel Reeves will cut VAT and adjust green levies that are on the coming through on our electricity bills, that could save up to £250 per household per year. Okay, what I would say to that, now that would get us to the £300 here, right? Almost, not far off of it. It still leaves utility bills immensely higher than they used to be. And the other key thing here is, why are we having this budget run up with the most speculation ever? Because as a country, public finances are in a dire state after the credit crunch 15 years ago, after Brexit, after COVID. We have and austerity before it, which meant we weren't really investing in infrastructure that generates tax receipts. So we don't have enough tax income. How are we going to pay for this? Is my worry, right?
Well, in 2 weeks' time, we might get a better idea.
Yeah.
Thank you, Julian, very much indeed, and thank you indeed for watching the programme. Any thoughts on what we've had to say or our guests have had to say, do add them in the comments underneath this video, wherever you're watching. We'll see you next week.
Hi everyone, I'm joined with Vincent from Flux Insights. We're going to discuss the major themes in crude this year, 2025, and some of the things maybe going forward. This is about the narratives, the themes, the positioning, some of the more nuances in Brent Dubai, Dated Brent, and all the rest of it, and just give a general overview, right? So Vincent, take it away.
For sure, let's get started. So talking about the key crude themes this year, you can't go without talking about the overarching narrative, which is OPEC unwinding their voluntary cuts.
Absolutely.
Which that has, the first tranche has been completed in September, and they're beginning their next tranche, the 9-member voluntary cut and the collective group cut that's supposedly ending by the end of 2026. Of course, that is quite, the market has a bearish interpretation, whether that's actually bearish for the physical, that's very much up.
That's what's been up in the air. So I think, coming into this year, they were actively unwinding on paper. They were calling for it. We're working through this kind of volume triangle, whatever you want to call it. We're about here, right? We're starting to get towards the end of this in theory, right? And we're starting to get to the last 2 million. But really, like as Jorge has been going on about, the officials have been going on about, the data is so spurious. The ideas, the talk of the super glut has been, just banded everywhere. Every trade house, every consultancy is looking at their supply and demand balances and saying, on this, in theory, data, this is what the result is, but we just haven't seen any evidence of that in the physical market, in the benchmark pricing. But then we're into that dichotomy of like how are benchmark contracts priced? They're priced by freely available oil and or traded oil, and of course sanctioned oil can build and build and build and be oversupplied, but not filter its way into the price. So that would be like, just to like lay it like straight away, this will drive hedge fund narratives. This will drive kind of tourist narratives. The market should come off because OPEC is supplying more. But really, I mean, just immediately from a crude trader myself, it's like, okay, I'm only ever going to position, if I really believe in this, and I really believe there's a lot more supply to come back, I'm only ever going to look at Brent Dubai as a proxy for, is it really happening? Brent Dubai has been negative for the majority of the year, certainly weak for the majority of the year, and actually went shockingly low, like -3, -4 levels in the prompt, after they announced the latest cuts. So it really doesn't really add up. But yeah, anything to add on that generically or about the narrative?
No, in terms of the physical market, we haven't really seen that weakness, as you mentioned. And
well, the physical market, oil and water, like we could get into that, but it's more the physical pricing of the benchmarks. We haven't really seen it.
And for the Saudis, they have a bit of spare capacity, but other producers, they were overproducing initially. So maybe they are maxed out in terms of their production, as well as Saudi, they're sacrificing their revenues for market share. So that's another big theme as well.
Do you think there's enough information out there, Financial Times, Bloomberg, etc., more generic, bigger media, have they reported enough on the fact that this data seems spurious that could filter into more of the touristy hedge fund narrative?
To be fair, Reuters did come out with a headline mentioning that only 75% of the supply hikes have been actually completed out of the stated amount. So a lot of the hikes is just notional, just the numbers only. Hasn't really. Not many countries can actually have the capacity to raise that output. So it's actually more bullish than stated.
Sure. But as you said, that's been the leading theme. Hedge funds have been shorting all year. CTAs have obviously been going with it. We've got Max short there. I'm sure you'll go into all this. And it has worked, largely speaking, right? We got down to almost, I think it was 60.07 on the very low of Brent. You've got the price, nice.
So this was in early April, and another big catalyst was the Trump's Liberation Day announcements, which also catalyzed a big sell-off too. So confirming prices down into the $60 range.
So going into, this is April. God, it's crazy to think back now it was at that level. But this is the Liberation Day tariffs and the carnage on that day. I know the market was positioned generally bearish as a kind of sentiment, as a kind of a discretionary trade, CTAs, and people holding puts. I think there was quite a lot of interest in holding some of the options, trying to see this like move down throughout the rest of the year. You got really paid aggressively on this move if you were owning puts in particular, because volatility absolutely split out. It's such a big move. Volatility roofed, and the price obviously moved down quite aggressively. So these kind of 60 puts did very well for a time. But what was immediately obvious there when the sell-off happened was when you compare it to other years, other years you're getting negative refinery margins, negative crude differentials, negative time spreads, and it's kind of flat price has to go because it's just a house of cards. It was kind of the complete reverse. Flat price did move, generated by a big like macro sell-off. The weight of the risk-off money in the hedge fund world and all that really kind of drove this down, it seems. But once we got towards the low 60s, the front Brent spreads just wouldn't move. And it was about 30, 35 cents from memory. And it was there. And it made you think, God, flat price moving like almost $10 and it doesn't want to budge. That is like the North Sea traders are really looking to own that time spread, which means they're really confident in the physical and holding the physical. So actually that became a buy. And then when we leveled out, that time spread went all the way back up to $1 positive. And if you're $1 positive on a time spread, that's just, you can't say anything other than that's a strong market. But that's my anecdotal thing there. Anything to add on the general theme being, bearish throughout the year because of OPEC? But is that really why it went down? I mean, who cares for a trader? But as in like all the signals whilst it went down kind of didn't really signal that we're actually oversupplied.
No, it felt like actually previously it was when Brent was trading between 70 and 80, it was always quite tentative, always felt like something was wanting to pressure prices down. And now then OPEC coming out, Trump's liberation day, the cat was out of the bag, gave the macro market really a reason to accept the lower prices when other players most of the market wants to be bullish. They finally accepted this lower narrative. But of course in the physical market wasn't so, didn't really indicate an oversupplied market. So it's more of a reset. Basically. Yeah.
Okay. So you'd be forgiven for retail traders, investors, people who aren't, oil professionals, would just look at that and say, OPEC are producing more, oil prices down, it's completely logical. But I think our initial review of this is like, it's very much a positioning thing. I'm not really sure it was about anything other than that because nothing followed through on the physical signals. But why don't we go to the next thing?
The next part, another key thing driving the markets, that was in June, the 12-day war between Israel and Iran.
Of course.
Which those attacks saw Brent spike into the 70s, even up to the high 70s for a few days until Trump came out, until a ceasefire was announced between the two countries, which this was a moment where volatility had really spiked. There were a lot of call options being put on, but as has been a theme over the past couple of years, the market really usually intends to sell into these rallies and geopolitical risk when, as soon as it comes out that, as they realize that the disruptions to exports or supply or infrastructure wouldn't be affected, that there wouldn't be a regional spillover in the war. So that's the main key theme. So market really sells into these rallies.
Yeah, there's a time decay to these things. There's high tensions and all the threat, but the tension can remain high geopolitically, but every day that real oil isn't being disrupted is a day further the market is starting to calling bullshit basically. And so you have a kind of natural time decay in moves like this. And then you also have a natural time decay in the options that you're owning. That is real value deterioration. But we were very vocal about this. Like you just said, we had the move down to low 60s. The market was comfortable with that because it aligned up with the OPEC narrative. It was seen as the tightness in the front, I guess, was going to be fleeting. You had consultants and banks, etc., talking about their supply and demand models indicating oversupply, just not yet filtering into the benchmark pricing. So that's when this started to filter. Sorry, this is when we started to get that narrative slightly shifting. The kind of feeling of, okay, I know you haven't seen it yet, but you will. And then it was like in Q4 is when you'll see the builds. That's when this narrative started to happen. So you still had quite a bit of short positioning here. So in this rally from 65-ish up to the peak, just below 80, because the market wanted to be short, let's say, from a discretionary basis, we said it was massively an options rally, wasn't it? It was a very local to call options is where the majority of the market put that trade on, which if you think about it, made a hell of a lot of sense because options are all about insurance, right? So you're insuring against a huge price spike, but you're positioning for it to go down. So you don't think this is going to last, but you don't know. And when people start talking about closing the Straits of Hormuz, well, that's actually a new thing, as in we've talked about it a million times, but the Iran are actually threatening to do it. You've got Polymarket saying, will they close the straits? And people are betting on it. And there's people in the straits themselves from ships talking about it. It was genuinely a threat. So if you don't believe that oil prices should be high, but of course you recognize some huge event could be likely and cause price spikes, you're going to buy insurance. So it was a massive scramble to buy call options. It was a massive volatility rally. But when it got to its peak, which was kind of like the Sunday night really, and you had weekend trading on IG and you had people like really thinking it was going to go on from here. As you said, that's when the market says, do you know what? They didn't close the straits. They talked about it in government and they said they wanted to close it, but nothing really happened. I think this has reached its peak. I think it's fever pitch. And this is when we got this really aggressive sell-off, which was really a sell-off in volatility if you were looking at the volatility on the options. And then of course the direct price, and that was kind of the end of that, right?
Sure. So it just ended very, very abruptly as well. That was when Iran struck one of the US airbase, US military bases in Qatar, and the market treated that as the ending of the war, because as in they allowed Iran to do that to escalate to de-escalate, and then afterwards Trump came out saying that both countries had reached a ceasefire, or he forced a ceasefire on them after the next day actually swearing on TV as well, which made both sides get the point. So then abruptly Brent returned to really normal, and then the market just returned to its old narratives.
You're a fan of Trump and his narratives. You always have been. You always comment on it, make jokes, all that kind of stuff. The point is that the new age thinking, particularly for a younger guy like yourself, is to be very in tune with the temperature of the dialogue. But if you go back, say, 10, 20 years, you're getting official narratives from governments, and you are really, genuinely believing in what the policy statements are and the conditioned narratives. And it's very, I don't know, in retrospect, very organized. These days, people are tweeting like Trump. There's all these threats from Iran. They're sending videos at night with like pictures of bombs, being like, this is it now. My question to you would be, on retrospect, where is the predictability in the chaos? Because like it kind of was, right? Like you're saying, they swear on TV, you get these kind of indications and you go, see that, I think that's de-escalation. You're getting a lot of transparency and live visibility into the thinking of these people. Do you see what I'm asking?
Yeah, exactly. Similar to the attack on the airbase as well. It's very similar to last year. There was the Israel and Iran also traded attacks to when Iran retaliated against Israel. That was very, very telegraphed. Talked about with intelligence and military, like the US military in advance. So that was when the market interprets this as kind of like a performance. Then it means that both sides have been given an off ramp, and this was the case in the Israel and Iran 12-day war as well. So
is the answer, because when I say where is the predictability in what's seeming chaos?
Yes.
Is it to recognize that it's a drama?
To recognize this, yes. Well, the official narrative would be to recognize that there wouldn't be any disruption to...
No, recognize that they're all playing games. And if you're comfortable with that, you can start to look for the signals. Whereas someone more, let's say, old school or kind of not, or a bit blind to the game and the agendas, they find it harder, right? They're like, hang on, this is chaos. Like,
yeah, so kind of reading between the lines in that sense.
Yeah. But it's funny because I think particularly the newer generations are finding it very comfortable, in fact, very relatable to see people like Trump, people like even the Iranian generals and these people, the propaganda, they're actually very comfortable with it because it's immediate feedback and you can kind of weigh up the feedback and people's comments, and the interconnectivity we have around the world it's actually incredible. In an event like that, you've got people on the ground saying, yeah, look, we're trying to get out of Iran right now. I'm blocked up. I'm trying to get I've got staff saying, I've got to leave because I've got to try and get my mum to the border and things like that. And you've got information that way, like live. You've then got obviously Twitter, people tweeting like all the time, threatening, we're going to bomb tonight. And then like all this kind of stuff. It's incredible how transparent everything is and playing out in front of you, that someone like me or you, just literally sitting in London, like watching from a phone, can get a very good sense of what's actually going on, and then we can judge it. You see me? I think your generation is very comfortable with that.
Oh, for sure. They also call OSINT, open source intelligence. So, and especially, for example, the Russia-Ukraine war, just to go on a tangent, there's a lot of military footage, and then often these military analysts online, they can interpret these videos from these various Telegram channels and judge based on like how much progress each side is making. So with this is you just really using the power of the internet and like geolocating things and using that to your advantage. And
so again, if we go back retrospectively to this event, I would say with AI, it's not like it wasn't here this year. So you can't say in the future it might be difficult in these scenarios. It's happening right now. Just to add on to your thing, someone might say, okay, well, if you've got all that open source intelligence, that makes you very vulnerable to a very well done AI video to cause a price spike and all that. We actually haven't seen that, have we? We've seen people take every video and go, I don't know about that. And it's actually quite hard to convince people that something's real until they see the hard evidence. That's quite interesting, isn't it? Like, for example, the Qatar thing you just said. We were getting live streamed. Those the Qatar bums. People were sitting in their balconies in Dubai and going, we're watching. And it's like, people need to see that, don't they? Because of AI, because of recognizing that you can manipulate videos. Is that a fair point?
Yeah, for sure. It's especially with the advent of AI, so many deep fakes can be created, not just of events happening, but also of famous people speaking as well. You really need to verify that. For example, when Trump said at the F-bomb, they were coming out saying that was not AI. He actually said that. So it's very interesting about like verifying information. If people react to supposedly fake news, then that really has an outsized impact on really people's positions, P&Ls.
But I think you said it quite well. The industry or the professionals are looking for this. They love this false peak. We know one particular trade house, but I'm sure a few trade houses were actually short volatility, did very badly on the way up, doubled down here and then made it all back, which is kind of as you'd expect these guys to do. They get caught out fine, but they recognize what's going on. They stay calm and they're ready to sell off when it happens. So this is where you're getting the dangerous area. If you've obviously maybe just a natural long position and you catch a spike or you kind of buying into this, fine. But when you're coming into, a few days of the crisis and you got people like Andrew Tate saying, I'm buying 1 million barrels of oil because of the crisis, that was more last year actually. But like, that's when you're like, ooh, we're looking peaky here. If Tate's getting long, if people like that long, exactly. You're like, it's too in the narrative and not enough has happened for us to believe it can go any further. You're right. That's when the industry's starting to think, okay, what's overpriced here? Because that will be a good risk reward trade. It's scary, but nonetheless. Okay. Let's move on from that then.
So onto a bit of positioning as we've touched on a bit earlier. So onto our Flux Insight CTA model. This is for Brent futures. We've been seeing that recently, particularly recently, CTAs have been close to their max short level. So we can see the rises and falls sort of in line with the price action. So during the 12-day war, there was a brief increase and then position slowly coming off. But what I wanted to touch on is that recently, as there's been more and more talks of the oil glut narrative, Brent potentially collapsing below 60. There's also a bit of technical analysis on that, but we've been seeing the CTAs were close to being max short. So what this means is there's not that much capacity for them to add new short positions.
It also creates a vulnerable market for spikes every time.
Which is what we saw recently in the last couple of days. So.
Exactly. So absolutely bang on. I mean, that's what I would emphasize too. But I think I would just say the theme of 2025 has been a saturation of this information. 2024, this was hot information. This was, everyone wants their data. Everyone kind of wants, from Bridgerton or Flux or whatever to be like, where are people actually going to sell this stuff? Sorry, where are the CTAs going to get their sell signals or buy signals? Because it's all relatively transparent. That's why we have these models. There's pre-programmed, momentum signals and data that they trade off. That's the whole point. It's transparent and methodical, so you know what you're kind of trading into, and it's just strict rules. But the point is that whilst that might have been interesting and people trade around at it last year, this year everyone seems to have it, right? And everyone is thinking the same way. And this is where it can get a bit dangerous. When there's positioning information out there or when things are too transparent, you're going, oh, well, that's at a maximum low or that's at maximum high. Okay, take the other side or I'm going to avoid hedging because of this, because of that. And it's like, it really can impact market dynamics. Because if I want to go and you want to go and we both stand off, the market can't really function as it's meant to function. A massive like tangent to that, but the same theme, is shale oil hedging in 2022 and end of 2021. There was a great article from the FT, and one of the shale oil producers was saying, I'm not going to hedge. Every single bank is out there saying oil's going to go to 150. Why the hell would I sell side hedge? And you're thinking, yeah, we're bullish too, or whatever. But no, that's terrible news, because if he doesn't sell, there's no liquidity for the market to orderly go up. So what's happening? That natural huge sell side volume we were getting before is now no longer there. So now everyone's just waiting for a price spike. And then when the price spike happens, people are scrambling to take advantage, or when it comes back off, people are scrambling to get the things off. So I would say that's starting to happen. And it kind of happens with any new information, like Genscape, when it first came out way before your time. Genscape preempts the EIAs, right? So the stocks. And so everyone's trading off it, making a load of money. But then everyone wants that information. Everyone gets that information. It's leaked out there. Then everyone's trading off that. And you've just changed the trading paradigm. It basically gets absorbed in. I would say 2025 is the year where this has not become obsolete, but everyone knows it. So don't think it's not priced in or not in people's thinking or whatever else. That would be my take.
Yeah, for sure. The democratization of information, right? When everyone is aware of this, then you kind of need to see new strategies, or to kind of think to when this previously had people thinking 2 steps ahead. Now you need to think 3 steps ahead of what's happening.
That's efficiency. Okay, so let's move to the next one.
Right, just a brief rundown on the technical analysis side of things. So as we can see, this is the chart for Brent futures over the past year, and there's been a lot of support at the $60 level, as we talked about extensively. Very psychological.
Very strong floor, right?
Very strong floor. Yeah. Previously, that was the $70 floor last year, but now that's acted as resistance. But last few days, there's been a lot of narratives about the oil glut, potentially prices falling under 60 when shale gonna be.
And again, the new theme, new narrative. But again, technically, you had that very, very strong support psychologically and technically, I guess. And the blue line is the 200-day moving average?
50. That's a 50-day moving average. And incidentally, that's where we've seen prices sort of see resistance over the past day. So what this means is that a lot of people, and at a time when narratives are driving the market, when there's a lot of algos, when there's a lot of volatility, people tend to look into the the technicals for their day-to-day trading, and these in the market as liquid as Brent futures, these moving averages, the psychological levels really play a huge role in where people buy and sell. And so looking at the moving averages, it potentially gives a signal onto where prices might see resistance in this case, or in other cases, the prices go down where they might find support. So this is just a snapshot of the latest take on where prices are going right now. But of course, overall,
we're very much at that moving average support line. I think that's incredibly important. And again, if it goes too far, we're going, what market regime are we in here? We've just flipped from a really weakening market, an acceptance that the glut is here because of the oil and water being the highest ever or close to the highest ever. The benchmarks are actually starting to feed that in. It's getting weaker and weaker in dated Brent. We've gone negative in the differentials to literally overnight, bosh. Okay. Now we had a bit of a short covering rally in dated Brent. We had, that actually seems like that was nothing to do with the sanctions. And then the sanctions came in. We've just flipped to a 2022, beginnings of a 2022 narrative, which is insane to think about, how you can go from almost max bearish to max bullish. And it's real, and I guess we're in that scenario where, that's why I brought up earlier, the market, I think, is aware, the wider market is aware that there is this dichotomy of freely available traded oil, and that being a market, and physical oil that's sanctioned, that's on water. The market's had to contend with that forever. I mean, the Iranian sanctions have been around for a long, long, long time. And that was always the case. You have these oil and water tankers that are just there. They're just constantly there. And it doesn't mean it weakens oil prices, because they can't affect benchmark prices. So this is like Iran on steroids, right? So I think people are aware of it and they genuinely believe in this. It's psychologically very, very hard to make money here, because if you're directionally trading and you've got into this narrative, people love to say traders shouldn't be emotional and they should be clear thinkers. It's complete and utter shit, right? The humans aren't like that. And also, it's just not true. When they form stories, they form narratives, that they are obviously going to get invested. So if you're so invested and then suddenly news comes out, you've got a hell of a lot of processing to go through to accept that you're in a genuine bullish market and then go, I'll first of all stop out, which is a hard thing to do for a lot of people, and I'm going to get long. You can flip long short if it's short term, but when you've been investing for a whole year in a short position and you've almost got to the break and you've maybe started this huge bear run, 30, 40 cents of Brent spreads to suddenly be highly backwardated, I don't think a lot of people made money there. I think the people who were already long in the North Sea, okay, they've done fantastically well, but that's more luck than anything else or insider information. But for the general market, I think this hasn't been a good thing. Now that we've got this like nice support line here, maybe it's a sign that we could steady for a bit. The market could kind of take a breath. And if this is real, or people are starting to believe this is long-term real, then maybe they can start investing here and there could be some decent money. But we know, obviously, Trump could go, yeah, sanctions over. So anything else on generic technical basis? I mean, has the RSI been useful this year? I mean, what's been useful technically?
I think the most useful thing is psychological levels and the moving averages. Especially if prices diverge too far away from these average lines, then there's bigger potential for a mean reversion. But in the sense that in the very short term, it's a good guideline for price action or for day-to-day trading in terms of informing when to enter or like position sizing, as well as when to stop out. Because if you want to, a lot of people probably may have placed stops just below 60, but we saw there was clear support at this level, and towards the moving average, we might expect prices to stabilize a bit more. So in a time when the markets are so volatile, chaotic, Trump can come in saying anything, reversing sentiment. Technicals are sort of a little a haven of sorts. Not that it's predictive of price action, but really helps with informing or providing a framework for risk management.
I agree. It's been quite effective because even if you look at this market, CTAs have been short all year. Well, they must have done okay. I'm sure it was very hard here because they were max short around here and then they had to cover. But, they're relatively slow to cover and then they were getting short again. And you have generally performed. It'd be amazing if CTAs haven't net done okay in oil this year. And from technical traders, they've probably done okay because if you're absolutely agnostic to the physical, you're not getting blindsided by the physical narrative, the gluts. You go, look, it's trending down. There's some quite nice patterns going on here. And I think it's generally been quite useful. It's traded quite faithfully to some of the core principles here. So yeah, all right, let's do the next one.
Next one, we move on to Brent Dubai. So touched on this a bit earlier. This is on an M1 basis, just quite volatile, but it's reached all-time lows.
Incredibly volatile. This is just for your sake. I've been trading Brent Dubai for a long time, right? 13 years, and the range is typically 50 cents being very much the low, really, to plus $4 being the generic kind of high. That's been a very solid range, and it's never really going through that range. It's either in a regime of low Brent Dubai or high Brent Dubai, and then you kind of have a regime shift, which takes a while to reprice, and then you stay there for a while. This has been, these ranges, you're talking about going from $2.50 to $1. So imagine that was 1 to 4. That's a considerable regime shift, but you're doing that from a negative to a small positive. This is like unheard of, right? So it was undeniably volatile, very difficult for the market. And I think the tourist trade, unfortunately for me, because I was always talking in the bull game on this differential, OPEC supply hikes, it was very low. Actually, we can go back here. And then you should expect a long-term rally as the market reprices because OPEC are back. It's pretty generic narrative, but it obviously should hold. What happened? It tubed and it tubed again. And you say, this is the announcement, right? OPEC announced, and then it tubed again. What's happening here? Well, you can say fundamental narratives, you can say physical narratives, and people love to do that. At the end of the day, this unfortunately is what makes trading the prompt very, very difficult, because if you'd held the back end this entire time, it's kind of been exactly what I'm saying, low positive and just kind of stayed there. I think we're max high 1 on the Cal 26 down to minus 20 now roughly. That's not too bad. That's kind of what you'd expect. In the prompt, you have to stay away a lot of the time unless you're going to be very, very careful on your position sizing, because literally anything can happen. And the narrative was Chinese SPR buying. We've got all the Chinese buying SPRs. Look, it turns out that was bullshit, right? Of course they're buying the SPR, but they always buy for their SPR. It was a pocket of concentrated buying that trade houses were able to use as an excuse to run all the tourists out of the market. All these massive longs that I think people were building up on this generic OPEC narrative. Bang, like let's just clear them all out, get them to all stop out, and then into the pricing month, just take everyone unawares. To get to -$2, it makes no sense, right? There's no justification. This is all about pricing dynamics and the trade house games. And look, what can you say? That's what they can do. That's how the Platts have set up that benchmark. You have to stay out of it. Easier said than done, and I didn't in some scenarios. But I think that at the end of the day, that's the only real message here. If you expect rationality, it's not going to happen. But just to finish off my ramble, I still think this proxy, this Brent Dubai differential, you can get it on Flux. Even if you're listening to this and you're a retail trader, you can still get Flux for free if you have an account and you're trading with us. Even if you aren't going to trade this differential, you should watch it like a hawk. Because if your leading narrative was OPEC this year, then I'm telling you, you can't short flat price or you can't get mega bearish until Brent Dubai really rallies. Why? Because if OPEC is overproducing, Brent Dubai has to rally because the Dubai has to reflect the weakness. Well, it has to be stronger than fucking negative, because that is suggesting quite clearly a very tight Dubai market. So if OPEC are going to bring back all this oil, you have to see that Brent Dubai correct for there to be even the suggestion that there could be oversupply in the physical market, and sustainably so into the pricing. If not, and actually that kind of proved right. I was very surprised we were selling off as much as we were when the Brent Dubai wouldn't rally. So it's all been a bit random, and that's kind of like, I'm glad you brought up this chart because it's kind of signifies best the year of trading crude. Why is Brent sold off when you haven't really got any logical moves off the back of it on something like Brent Dubai? The CTAs have all been max short, and the physical traders are probably thinking this doesn't make any sense because the market's really tight. I should buy. It's been chaotic. It's not been aligned. It's not been clear. Like in 2014, we had a Brent Dubai rally. We had the physical diff sell off. We had the time spreads go negative. We had all this happen and Brent selling off. It was a very orderly rally on retrospect. It's been nothing like that this year. It's been inverted.
Yeah, very, very much so. It just goes against the logic that you would usually expect.
Basically, yeah. That's what I'm saying.
And to refer to what you were saying earlier about the Brent Dubai previously trading very high, this seasonal chart from Flux really illustrates that. So the white is from 2025, and since last year, really, prices have been...
This is only for the last 4 or 5 years, but even so, it's still the case, right? Like 2022, which is the real, obviously, ridiculous moves we had. Look, it's so high, and that's with Russia being taken out of the game, right? How are we this negative? How do you create a fundamental justification for Brent Dubai being this negative? The answer is just positioning, just not to repeat myself, but yeah, that's it.
I mean, yeah, people do find fundamental reasons, but overall it is just the buy market has been super tight. Although the last couple of days we did the increased sanctions on Russia, where you would
this is actually a bit more of a logical sell-off. I agree. Is that what you were going to say?
Yes.
Yeah. So this one we kind of gapped down, didn't we, in the prompt? It made sense because again, back to this freely available oil versus sanctioned oil. So the freely available oil, if you want to trade the Eastern, you buy, Al Shaheen, you buy Murban, you buy the local grades in the Middle East or the Saudi crude. Now, the Indians in particular were buying all this Russian oil. Now the secondary sanctions have come in that they can't even buy, or they don't want to buy that oil anymore. They have to go and buy Al Shaheen or something like that. And Al Shaheen directly prices Dubai benchmark. So that had to create a bullish impact, and Brent Dubai had to sell off, fundamentally made sense to, and I don't think people were going to stay in the way of it this time. So I think there were stop outs here, and I think there was also a lot of belief that you can't stand in the way of that. So I agree with you, and maybe now it can become a bit more logical now, who knows.
Yeah, sure. So yeah, that's just the whole of the Brent Dubai in a nutshell. So against a bit of logic, but recently, as I said, Russia sanctions, more tightness here.
Yeah.
So that's Brent Dubai. Lastly, we'll have a look at the North Sea crude market. So this is just a snapshot of the Dated Brent physical differential, as it goes ups and downs depending on the supply and demand dynamics, the trading, the positioning, of the physical guys. Recently, we've seen a big,
It's like a
collapse.
CTA graph.
Almost, yeah, almost. It's just a bit of a seesaw effect going on. Recently, people.
Let's just quickly explain this for people who don't know, right? This is, again, it's not easy information to get. You can get it from us. But this is the physical differential from a Platts perspective, right? From the PRA perspective. This is what they're using to set the price for dated Brent, which in turn will set the price for all the differentials and then ultimately Brent time spreads. So generically speaking, even if you've got no interest in trading some of the dated Brent contracts we have on Flux, etc., you should still look at it to get an indication of what the physical differential is. And that will link very tightly to the Brent time spreads. And the Brent time spreads in turn will give you a good indication if the market is strong or not. So that's why that's so important. Basically, look at this like a time spread. Yeah, so we've been going from negative 3 times in the year to incredible spikes. Again, this is what's just nuts. It's like Brent Dubai. It's like you would expect in a typical regime, you're either strong and you're kind of 40 cents to $1.20, let's just say. That's a very healthy, strong physical market in my experience in 13 years.
Yeah.
Then what will happen is it will reprice and the range will be $1 to 40 cents. And that's how it goes. Just like I was saying with Brent Dubai. And you see all the correlations in the wider market. It might be a bit choppy, but ultimately the market's either strong or weak, basically. This year, we've gone from pretty damn weak. 50 cents. It got down to 50 cents again a couple of times more recently. Okay, genuinely a regime of bearishness.
Yeah.
To a flip to unbelievably bullish. It honestly does blow my mind a bit because it just shows you flipping from so bullish to so bearish and flat price kind of nicely trending down didn't really make sense. It just shows the chaos again. We're kind of repeating ourselves, but that's what I get from this graph. What else would you say?
Yeah, it's just lots of ebbing and flowing. It's just more recently in the last 2 months as talks of the oil glut, the increased supply narrative comes back online. As our viewers might recall, for October, November, Brent futures expired. Retail took on a lot of barrels, and then also so in recent weeks, the physical was quite supported up to $1, and you had headlines coming out from Bloomberg saying, it kind of almost goes against the narrative of a supply glut, but then the physical differentials came off into the last 2 weeks as as the market became a bit more oversupplied, cargoes were struggling to clear. And but then all of a sudden recently, we still need to update this, but the physical has been rallying again. It might be a bit of a short covering.
It's on its way up, and you can get an indication from the CFDs, data Brent CFDs, not to be mistaken with retail CFDs. This is the CFDs and data Brent, and they're interesting to track because you can get a forward indication of what the physical differential is going to be, or at least the market's interpretation of what the physical differential is going to be. And that is looking strong. That's looking like it's going to bounce back up, which does make logical sense. But I massively agree with you. The supply gut story has always been here. It was concentrating in the last few weeks. And one of the major reasons was this sell-off here. This sell-off in physical differentials, one down to negative, was the more classic repricing you would expect. And I was really genuinely expecting, right, here we go. This goes down negative. Every time spread in Brent is not deeply backwardated, deeply contango, but meaningfully contango, minus 10, 15 cents, 20 cents a spread. And there was only one spread, or maybe Jan Feb as well, slightly, two spreads to go. And it's over. It's a contango market. We're in a regime. That is what you'd expect. And it did look like Brent Dubai it kind of started to make sense. Brent selling off, Brent Dubai picking up, physical differential selling off, and then bang.
Yeah.
For fuck's sake. That's why I say I struggle to believe that people made a lot of money on this, because you are looking to trade this repricing and it's all making logical sense. And then you get a black swan event. So you pick up again. The question's going to be, in everyone's mind, do you get long? So to your point, Vitol buying a hell of a lot of cargoes expiry, other trade houses owning oil here, they've gotten super lucky, right? They're gonna do very well. Fine, that's the way the game goes. But having said that, once it prices and you've made your money, are you going to get long again? Are you going to genuinely take on the physical again and expect this market when you know how vulnerable it is to a sell-off? And all you need is to Trump to tweet at 12 p.m. or 12 a.m., whatever, and say, I've agreed to remove sanctions. All that oil and water, like I said, Iran on steroids. Whenever it would be announced back in the day that Iran sanctions were going to be relieved, you knew all that oil was going to go find homes. It was unequivocally a bearish event. It's that so much more. We've got so much oil and water. If you remove the sanctions or a peace deal is made, I mean, it's like 1 billion barrels. I don't see how oil doesn't go negative again, or at least threaten to, in a short period of time, whilst the market reprices and clears this oil. You might not see oil negative in the benchmark prices, but you will for sure see a lot of people struggling to get rid of the oil and paying people ultimately to get it cleared so we can start again. So honestly, I wouldn't put it past the market to price incredibly strongly in the next few weeks, rest of the year, but then also be vulnerable to an incredible price dump. So I mean, buy volatility, I guess, is the only thing left to really say on that side of things.
Yeah, for sure. Buying volatility and the post-sanctions trade, there's going to be a lot of adjustments being made. That's for sure.
Yeah, and you know what? Even as we're saying this, it's a Friday. What's the date? Whatever we are. We're launching next week. This will be online and part of Flux News. Man, think how much could have changed in the next 3 days. So look, just so the audience knows, we were on a Friday, just only a day after the sanctions were announced, or a couple of days after. So we don't know, but it could literally be the weakest market ever or the strongest market ever next week, which is nuts. But yeah,
for sure. Another really important, some interesting, a bit more niche chart I want to bring your attention to is looking at the actual physical differential versus how the data Brent, how the forward curve was priced a week prior to expiry. So that's for the weeks.
This is data Brent implied. You're looking at the CFD curve, right?
Yep.
CFD curve, the market anticipation of data Brent versus actual. This is a great graph. Yeah, thanks. Sorry, just wanted to make that clear. Go on.
Yeah, so on the left side, that's what was implied on the CFDs, and that's blue bars, and the orange bars was the actual physical differential, how the actual market was priced. And over the period of summer, there was a period where refinery margins were super strong off the back of stronger distillate cracks, gas oil cracks. And so the narrative was that triggered a lot of refinery buying, especially in July and August. So hedging the cargoes on paper. So the paper implied was really high, but when it came to the actual physical pricing,
but when is the snapshot? So is it like 3 weeks forward?
1 week forwards.
1 week forward, but you could even go 3 weeks forward. That would be very interesting as well, because 3 weeks forward, and if you go to like 13, 17 week in October, people were pricing that at plus $1. It priced minus 50. So that's when, again, that's another signal to be like, bosh, the market's cracked.
No, yeah.
So
sure.
yeah, but your point is what? That it just struggled to actually reach the heights.
Yeah, for sure. So during a full period between July until September, it's if I have the numbers right, the actual physical was weaker than implied for 14 weeks in a row. So in theory, if you were to short the 1 week roll into pricing, every single week would have made money for.
But again, straight. That's a very nice physical signal. Sorry, a bearish signal. I'd be looking at it's really struggling to keep up here, and it just re-emphasizes the same thing we're saying. But there's great analysis. Like I think it's a shame you don't have that week, because I could show that. But other than that, like you need to get this out more in the reports. Like people should be clambering over you for this information. It's not easy to obtain, but you'll supply it, won't you, Vincent?
Oh, for sure.
For a cost.
For sure. So lastly, refinery margins looking forward. Of course, it's closely linked to how the demand dynamics in the data Brent market, and margins have been creeping higher since the start of the year. This is the M1, and gasoline cracks, diesel cracks have all been really supported. So, and in line with this, we've seen physical strengthening off the back of the sanctions news, and margins are pretty strong as well. So this makes, at least from my perspective, a bit more bullish going into the winter time, especially refiners coming back out of maintenance. There's going to be a bit of demand coming online, as well as the fact that if margins are in a high environment, then some refiners may be looking to defer their maintenance schedules come spring. So there's very much a bullish thesis for data going afford if you come.
Well, and as you saw on your previous slide, like you said, the refiners are buying those CFDs to hedge this kind of thing, and you get the indications. It's got real paper impact on the dated, which then impacts the Brent spread. So don't think that that's irrelevant. Like that's super important. I agree with you. I just wanted to add, going into the year, reasonable margins. This spike, the market has been pricing on a refinery margin basis as if the market has, or the world has, a lack of refinery capacity. And to some extent, that's probably true because of Russia being bombed, maybe that kind of thing. And China probably not running their refiners anywhere near what they're capable of doing, like more like 50%. So it kind of makes sense, but it's also pretty crazy. And I agree with you. It's hard. It's a very bullish signal to have such strong margins. And for them to be up in this is European, remember, not Asia with the sophistication. This is European crappy refiners making a hell of a lot of money. They've all been wanting to sell their refiners for like the last 10 years, but you've held on to them. You would have made money, quite a bit of money. And I think when it's as high as $9, it's so hard to look at that and say, are we actually in a bearish market? And then, but to challenge that a little bit, we were selling off. This sell-off, the latest sell-off from 950 down to close to 7 was happening with the physical diffs coming off. Just to repeat myself, everything was coming in as you'd expect. And the problem with margins is if the demand is relatively healthy, but you've got an oversupply story, then you can justify having low crude prices and high margins because the products just are a bit more sticky, but the crude is getting, so it kind of makes sense. So you justify to yourself, it's okay. It makes sense that margins are high because crude's weak. But the problem is, can you really get a proper sell-off if their demand is still kind of sticky? And we've seen a considerable amount of consumer hedging at every point at every major sell-off. The tariffs, that sell-off we talked about earlier. Do you remember we were talking about this podcast earlier on in the year? Like insane amount of consumer buying from fuel oil. Then we got to recently with the sell-off when we got close to the 60 figure, the most ever jet fuel consumer buying, people are saying, from a hedging basis, like really, really concentrated buying, like quite unusually so. And that does have a bullish impact on the margins and the overall flat price. So what I'm saying is a real sell-off, if you like, will be completely undeniable on a margin basis and on a flat price basis if there is a demand shock. So that's maybe been the problem, if you like, for the market to not really follow through on this bearish move. I think we've got to see the recession that people are talking about. Yeah, UBS was saying it's like a 93% chance of recession now in the US. Okay, well, if that's the case, then you will get demand destruction and you will see these margins weaken. And once these margins are down into negative territory, it's going to be the complete flip. There's going to be a lot of reasons to sell off and to not hold up. But we're nowhere near that right now.
Yeah, for sure. So very much an oversupply story. That's the narrative of the past year. So demand has been keeping up, but there's just been more supply coming online.
Yeah, but like you say, like when you have shocks and you have maintenance being over and you've got refiners for reasons to buy the paper, it's hard for there not to be a big bullish impact. And then when you have CTAs max short and the market's so short, it creates vulnerability to these market roofers that we've periodically seen. And that's, I mean, I think we've done hopefully a relatively good job there over the course of this podcast to really emphasize when people say it's been a difficult market, this is why. Because you get it a lot. You know, it's been volatile. Surely it's been easy to make money trading. And the CEOs of Gunvor and Vitol and stuff were asked this as well. Like, how's the market been? They say it's just been very difficult. And people generically don't understand what that means. This is why you get this bullish signal versus this bearish signal. You've got oil and water versus very tight free markets. You've got all these things going on. You need kind of, yes, volatility, but volatility around kind of correlated indicators that over time can create a regime shift or a repricing. That's what the market was looking for. It didn't get it. So you're getting winged and wanged everywhere, and it's very difficult.
Yeah, I suppose like the difficult kind of volatility, especially with the US administration comments and stuff as well.
Yeah,
usual
100%.
Yeah, all these changes.
Yeah. Cool. So should we finish maybe just quickly? You know, as I said, we are doing this podcast only very recently after the sanctions have been announced, the latest sanctions, and a lot could change. But going into next week, should we put some predictions in place? What do we think is going to happen? How do we think things are going to pan out?
Yeah.
Go on then. So we've got the CTAs probably still need a lot to buy back. There's a lot of capacity for them to buy back. We've got refining margins, very strong. We've got the Russian refiners still getting bombed. We've got a lot of bullish reasons, and we've got a big paper unwind from the market being so bearish for so long. the longer these sanctions maintain, the longer the market believes in them, the more time the market has to flip their positioning materially long. So I think it's obviously contingent on that, but I think we can easily go back up to the 70s here, and it could be a very decent bull run. Brent spreads, basically a full bull narrative. That would be my prediction if things are going to stay as they are.
I think so, yeah. But to speak of what might happen on the opposite end, if Putin comes to the table quickly, and US have mentioned publicly that potentially sanctions relief for freezing the front line, all of that as negotiating tools. So if that comes out, these headlines come out, then we could also see a rapid unwind as well. So as to we need to look at, like, the traders need to set stop out levels very cautiously.
I think so, and I think momentum trading could work. But remember, when you get bullish and you get volatile, it's tough.
Yeah,
you get chopped in and out of trades. My take would be trading from the long side, but the higher we go, start to pick up cheap put options. Because there's no, it's like a COVID event, right? If imagine being told COVID could happen. You're okay, I'm going to buy some fucking $20 puts, because if it does happen, it's going to really aggressively get there. I think the market is signaling that to us. It's saying, right, trading for the long side, but if Putin makes a deal with Trump and like it's happened overnight, then you really can, with all that oil and water, go from 75, 80, I don't know how high we're going to get, 85. You can genuinely go down to $30 with how much we've got, and how much positioning and how much carnage can happen all at once. So the only trade there is long volatility. So you have to own an option, you have to own an out the money put, and you have to, obviously, when that happens, price in the volatility roofer, maybe at that point, take it off and have a short position, whatever. The point is that could very easily happen. That might become a crowded trade, but basically long outright, the higher we get, the more you're buying out the money puts, will be my thing. And you could do the same with time spreads. You can buy CSOs on Brent spread puts. You can say, as we get to $1, $2 backwardated on Brent, if that's going to happen, you can start to look at the deferred curve that's been dragged up and start to buy, minus 60 or minus 40 put options on the spreads. That would be my take. I wouldn't do it in gas oil, because gas oil has still got that Russia situation. It's still got all that consumer buying. Clearly, there's still demand. But at the same time, if there's a macro sell-off and there is a recession that comes in and all this gold unwind and everything, that kind of stuff, then yeah, you could get washouts everywhere. But that would be my take. Anything else to add?
Yeah, I think with these hypothetical trades, one would be covered on both sides for sure. So you can, like, on the rally, flat price, right? And then if things go the opposite side, then the puts will have you covered.
Yeah, I'm not trying to say buy when the market goes up and sell when it goes down. I think the market will go up as it is right now.
Yeah.
But because of the shock decision, the best way to trade a shock decision is to have a put option. And actually, if you had them in the tariffs, like I was saying, you got paid very quickly in 2 days, and then you're out of it and you start again. That if you're not in it, you'll lose it. You know what I mean? There won't be time to sell on the way down. It will be too aggressive. So you're going to need that insurance. Great. Vincent, thanks very much. That was very thorough. And thanks again, viewers out there. See you again soon.
Happy Friday, folks, and welcome to the last episode of the European Market on Close for this week. And it was a very silent one. Both players in both sides of the North Sea looked like they had a heavy lunch. Nobody was there either bidding or offering. Very quiet window. Vitol surprisingly didn't offer any cargoes today, but they were very active in the BFOE partials. Both January and February BFOE partials, they were actively selling today. So yesterday, just to do a recap, we had the lowest ever assessed physical differential, as we can see on the chart here. The lowest ever by the officials are around minus 1.08. But this today, as we had no action and our curves are in contango, and they're obviously stronger at the back, we should see some strengthening going forward. Now we're hearing from trading sources that many players have switched actually buying CFDs for the next week, which would theoretically imply stronger expected demand for Dated Brent next week. So we should expect the physical differential to head up. Now, if we were to move into price action over the market, the major news today was the port that was hit by Ukraine in Black Sea. Basically, what we're hearing currently from sources is that from the Caspian pipeline, crude is flowing towards the terminal, and we're actually see ships being on the terminal ready to be loaded. So that's good news. No supply looks to be impacted because that's a big terminal. It transfers around 700,000 barrels worth of crude and another 400,000 barrels worth of products per day. So it's big news. Flat price though hasn't really reacted. We had the major uptick in the morning in the open. So since the open, we've rallied about $2 higher, as we can see here on the chart, and we've traded pretty range bound, I would say, from the $63.50 to the $64.50 mark. So we remain pretty elevated compared to previous sessions. Now, if we were to move on to Brent spreads, the prompt Brent spread, as you can see here, rallied to almost 60 cents in the morning, but quickly fell after that to around 40 cents, and it's been pretty range bound. Even though flat price remains elevated, we're currently around this 40 cent because everybody, quite frankly, speaks about this super glut that we, the officials, are quite skeptical about it. But anyway, what you can say? Over to CFDs, where we see in the physical market, CFDs are strengthening, as you can see here on the Flux terminal, all across the board. Obviously, Balwick and the week one are currently into negativity. All the CFDs here are pretty much around 30 cents stronger on the day. So that's good for Dated Brent. Remember, Dated Brent has been very, very weak in the last few sessions. We should expect a slight uptick according to trading sources from what they see in the over-the-counter market and on the window as well. So that's it for today, and that's for the week. We hope you have a lovely weekend and see you on Monday. Thank you very much.
you.